You're starting to see inflation peak, but where are we going to level out at?
We're near a great shock. I don't know if we're going to unravel.
The markets are doing 110% of the Fed's job.
There's a lot of room to go for financial conditions to tighten and really for the Fed to deliver on the hikes.
The question is, will there be, for example, further shocks to the system that mean inflation stays elevated?
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Equities rallying hard this morning from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. TK Futures up 1.8% on the S&P. Retail sales just around the corner.
A couple-day lift. I look at Standard & Poor's 500, John, and off that low under 4,000 on SPX, we're nowhere near the midpoint. That's how depressed we've been. But we're working our way back, and you really wonder, within a bear market, end of bear market, whichever it will be, is there something in the wind about China and the end of a lockdown?
Looking ahead to the data as well a little bit later, stateside. TK, we know how the consumer feels. Dreadful. Sentiment, a decade low. What are they doing? We're going to find out at about 8:30 Eastern.
Retail sales is going to be a huge, huge deal. It's not only the control group where they take out all sorts of variables that the pros don't look at, but really the consumer spirit that's out there. I love that we have Dana Telsey, before we get to the economics and retail sales, about what's actually going on in the stores.
A lot of retail sales earnings through the morning. Home Depot, Lisa, just out.
Yeah, and that really beat expectations across the board and raised fiscal guidance for 2022. This comes after the shares were absolutely pummeled so far year to date. First quarter comp sales up 2.2% versus an estimate of being down by 2.44%. The EPS came in for the first quarter at $4.09 versus $3.86. I got to say, John, how much are these specific stories of individual retailers able to cater to a lot of clients who are trying to price down versus a wholesale continued momentum in the consumer?
What are we pricing in? Home Depot year to date down 28.68%.
Exactly.
Coming into today, we're firmer in the pre-market. The home builders this year, absolutely dreadful. Guess what? Right on cue, Marko Kolanovic of JP Morgan out just yesterday saying he remains pro-risk. And why, Lisa? He thinks we've priced in too much recession into this equity market.
Okay, he's the biggest bull on the street. And you were saying earlier when he capitulates that everybody can get in there.
I think we're all waiting for it.
And get back in there. But honestly, I mean, when one person keeps saying the same thing over and over again, you know, if the price goes down, you only like it better, right? It's a sale. And he is consistent in that message.
When the big bull turns bearish, it's usually some sort of sign. I'm not saying it's Marko Kolanovic that we have to focus on, although maybe I am just a little bit. Tom, highest cash levels since 9/11 in the Bank of America Fund Manager Survey.
Huge deal.
Growth optimism, record low. Biggest equity underweight since 2020. We've priced in a lot.
I'm going to go to the cash level. This can be a number of things, John. It's just the cash out there. But by prospectus, most long-only buy-side mutual funds, things like that, have very rigid cash brackets so they can get up to a peak of cash and they really can't go more by prospectus. So to see that cash level back to September 11 of 2001 is a huge deal.
We'll catch up with a man who's holding some cash, not Tom Keene, in about 2 minutes' time. Futures positive.
When you leverage out your cash, it works
on the
out.
S&P. On the Nasdaq 100 up by 2.4. Hold that thought, Tom. Yields up by a couple of basis points, 290.58. And euro dollar 104.77, firmer there by 0.4 on that currency pair. Lisa, George Saravalos over at Deutsche Bank with some things to say.
Basically saying he sees this going to 110, not to parity, because frankly, any kind of additional downside risk will just go to this fear of a slowdown with possibly the Fed not tightening as much as people are expecting, and the Eurozone prepared for perhaps being a bit more hawkish than people currently expect. Today, it is all about retail sales. The retail bonanza already began with Home Depot reporting better than expected earnings. Walmart reporting at 7 a.m. Eastern. U.S. April retail sales at 8:30 a.m. The S&P Retailing Index, just to give you a sense, the subsector here, down well more than the S&P, nearly 28% year to date. How much have we baked in of some of the deceleration of spending that we haven't seen quite that much. Last time we did get retail sales, they did come in negative on an inflation-adjusted basis. At 10 a.m., housing. I am so focused on housing. When do we see it roll over after all the increase in mortgage rates and just pricing people out? We get the home builder sentiment survey coming out at 10 a.m. I want to point to the employee construction workers index. Basically, the people working in construction, when that rolls over, that tends to be a recession signal. It has been consistently since the early 1980s. How much do we start to see that reflected by sentiment in the home builders? And meanwhile, it is Fed speak bonanza. Basically, 1/3 of the entire government of the Federal Reserve is going to be speaking today, headlined by Fed Chair Jay Powell at 2 p.m., James Bullard, Patrick Harker, Neil Kashkari, Loretta Mester, all of these people coming out, including, of course, Charlie Evans. Who isn't speaking? What are they going to say? How do they really message this going forward, John? What insight are we getting from Fed officials who come up and say, I don't know, we watch the data?
Particularly after some interesting criticism by the former Fed Chair, Ben Bernanke.
Yeah,
I think that makes things very interesting, Lisa. These former Fed officials are not holding back.
I would agree. Ben Bernanke coming out and said they made a mistake, they missed the boat, they're facing stagflation. That is so unusual for a former Fed chair to come out and criticize the standing leadership. And that is what we saw out of Ben Bernanke.
What would you prefer to talk about, the Fed speak or Twitter? Twitter right now, here you go. In the pre-market, the conversation looks a little something like this. Twitter committed to completing the deal with Musk on the agreed price, which, Lisa, is $54.20. And the number beside you is not $54.20.
This means, to me, that the deal is off. Because basically, it seems like Elon Musk was looking for an out after having buyer's remorse, or at least offer remorse, saying perhaps he didn't necessarily want to pay $54.20. Twitter saying, we're still going for $54.20. John, how much does this mean the deal is off?
It's Elon Musk saying overnight Twitter must prove the spam proportion for the deal to proceed.
He's got his own rule book, and he's going to have it handed to him. I mean, there's a $1 billion fee, John?
To walk away?
To walk away. You know, how far does that go into executive compensation at Twitter? I don't know. You know, the whole thing from day one has been a mess. Where were we, a 54 mark? On Twitter, and now down there, that if I'm a shareholder, my head's spinning.
At $54.20, the agreed price.
Yeah.
$36.90, the price in the pre-market, down 1.4%. TK, we'll touch on that a little bit later. Joining us now, a man who has been holding a fair bit of cash. It's Russ Costrik, portfolio manager of the Blackrock Global Allocation Fund. Russ, let's start there. You've been holding a higher cash level than normal going into this mess. What have you been doing with it?
Good morning, John. You know, we haven't been doing much is the short answer. We have been holding a high cash level. Represents a couple things. One, a little bit of an underweight to equities relative to our benchmark. And it represents a big underweight to bonds, which, you know, thankfully, that's been the right call, the right trade year to date. But we do think we're getting closer to a point where you want to bring some of that back, but you're probably not there yet. And, you know, this question about has the equity market bottomed? Are we there yet? I think it's the right question. When you look at the sentiment numbers, clearly, as you pointed out a moment ago, there's just a lot of pessimism in the market, more than we've seen in years. The flip side to that is we haven't seen inflation like this in years. And to me, the big issue you have to resolve is how far is the Fed going to go? How much do financial conditions tighten? And what is the right multiple in an environment that may look somewhat different than what we've been used to in the post-GFC world?
You have a lot of contacts in China with Jeff Shen and others, Russ Costrik. What does the end of a lockdown in China mean, not only for Asian assets, but for BlackRock assets in the Western world?
Well, I think the end of the lockdown in China, Tom, is going to be constructive for the global economy. And, you know, again, you all were speaking about it a few moments ago, the recession chatter is picking up. And there are many reasons for that. But one of the reasons is you've had China, at least large parts of it, shut down over COVID restrictions. And that has been a drag on the economy. We've seen in the retail sales numbers there. We've seen in other manufacturing data. If you start to loosen that up, if some of those ships off the coast of Shanghai can start to move, that is going to help remove one of the headwinds that the global economy has been struggling with over the past several months.
Russ, you said that you still have a lot of cash. You're not ready to deploy it yet. When you do deploy it, what are you going to be buying and what are you waiting for to really say, let's go?
So I think there are a couple things. You know, one, at some point, you know, again, unless you think the Fed is going to have to go to 4% of the Fed funds rate, we're probably getting closer to the move in long-term yields, whether that's 3 or 3.25. Again, we have to look at the data. But a lot of the adjustment, a lot of the repricing in long duration rates has probably already occurred. At some point, there's going to be a benefit in rotating back. The other place where, again, I'm not sure you're there yet, but it's starting to get interesting, some of the growth names, particularly profitable growth. We're not talking about early growth, talking about profitable growth. This part of the market has completely given up the pandemic premium that went into it in 2020 and the early part of 2021. We're seeing a lot of names in mega cap tech that are highly profitable, that can maintain margins, that are trading at a huge discount to where they were 6 or 12 months ago. If the rate side of the economy starts to moderate, then I think there's an opportunity in those stocks as well.
Awesome to catch up, Russ. As always, Russ Costrik there of Blackrock, just working through what would lead to capitulation, I guess, to some degree. If you're sitting in cash, when would you deploy it? This B of A fund manager survey is often talked about every single month. They ask about 331 panelists with something close to $1 trillion in assets under management, a range of questions. And then Michael Hartnett offers you some commentary from B of A as well. And this is what he had to say. We're missing the full capitulation piece. Tommy said investors still expect rate hikes and not rate cuts. Stocks are prone to an imminent bear rally, but the ultimate lows have not yet been reached. The words of Michael Hartnett and the team over at B of A.
To me, it's easy to measure in a VIX, and Dean Kern out with a short, terse note this morning. Above 30 is some angst, and somewhere in the vicinity of 40 on VIX is where you get that capitulation historically. John, the VIX with a big lift today, NASDAQ up 2.3%, is 26.54, and this is confirmed across all the data, John, on my Bloomberg, most particularly in ages. Strong renminbi gets my attention.
And that inverse correlation between bonds and equities, Lisa, it's back. It's back over the last few weeks. We're starting to see equities climb and yields climb.
And also Russ Costrik saying that that's probably a sign not to deploy that cash yet. When you see stability in yields, that's the go. And honestly, that seems to be a consensus among many people.
Futures up 1.9 on the S&P, on the NASDAQ up by 2.3%. In the next hour, great lineup of guests this morning. As always, Jan Hatzius of Goldman Sachs, the chief economist, joining us in around about 50 minutes from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Elon Musk says he'll go ahead with his $44 billion takeover of Twitter, but only if the company can substantiate its claims about the proportion of bots on the service. Twitter says fewer than 5% of its accounts are fake. Musk says he believes the number is a lot higher. Meanwhile, Twitter says it is committed to completing the deal at the agreed upon price. The euro area economy grew more than initially estimated at the start of the year. GDP rose 0.3% in the first quarter. European consumers emerged from the pandemic with pent-up demand and large amounts of savings. Still, the war in Ukraine has added to cost of living concerns by stoking up energy prices and adding to already record eurozone inflation. Turkey's President Recep Tayyip Erdogan has put the brakes on NATO's Nordic expansion. Erdogan says he won't allow Sweden and Finland to join the alliance because of their stances on Kurdish militants. Erdogan called Sweden a nesting ground for terrorists. Several EU defense ministers are optimistic that the Turkish concern can be resolved. And the accused shooter in the Buffalo massacre has discussed his plans for the shooting for months on the popular chat app Discord. That's according to logs of his post reviewed by Bloomberg. In December alone, the suspect referenced his plans to commit the attack at least 17 times. Discord says it is cooperating with law enforcement. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Continues his heinous war of choice, the Biden administration will work with you and our other partners to push Russia further towards economic, financial, and strategic isolation. Eventually, Ukraine will need massive support and private investment for reconstruction and recovery.
That was Janet Yellen, the US Treasury Secretary, speaking at the Brussels Economic Forum a little bit earlier today. From New York City this morning, good morning. Futures are positive in a big way on the S&P and on the Nasdaq as well. The Nasdaq 100 up by more than 2%, the S&P up by 1.8, yields higher by 3 basis points, 291.13, and supporting the improving sentiment for now, Home Depot with a beat and a raise for the full year outlook. Their guide is higher. The stock is too, up by 4.4%. TK, speaking to the inflationary moment we're in, customer transactions fell in the quarter. The average ticket price, guess what? It increased.
Well, there's the inflation there, and of course, it's all going to be reported. Retail sales is not inflation adjusted today, but the fact is, it's once again Home Depot to the rescue. John, 22% per year is the Home Depot performance in the last 10 years. Apple up 24%. I guess they're allowed to pull back every once in a while.
What does the future hold, though, Tom? That's the focus now. Do things get worse, not better?
You know, shares into strong hands is really what's going on right now. I'm absolutely fascinated by the moment, John. I really don't know what else to say. I'm riveted to the VIX, 26.67 on the VIX, way in from a 30 level. Right now, Emily Wilkins with us with Bloomberg Government. And she knows that the triumph of Pennsylvania was to connect Philadelphia with Pittsburgh. John Ferro needs to get on the Pennsylvania Railroad, Emily, and go out to Altoona and Horseshoe Bend, which is an absolute miracle, folks, of where literally your train turns around in a circle. It also describes the Republican Party this election day in Pennsylvania. How much of a bend is the Republican Party screwed up in Pennsylvania, Emily?
I mean, we are going to see, this is the race to watch today in a day where there are a number of newsy races happening across the country, is the Pennsylvania Republican Senate race. I mean, you had Donald Trump come back, Mehmet Oz, the former famous TV doctor, and over David McCormick. That was already a sort of a big factor in play in seeing where Trump's endorsement was going to be. But now we've seen a late surge by a candidate, Kathy Barnett. She's a far-right candidate, even further to the right of the candidate that Trump endorsed. She's a black, she's a woman, and she's really gaining a lot of momentum. And I think this is a race that a lot of people are looking at to see, A, the power of Trump's endorsement. Does his candidate win? Does Oz win? And then B, if he doesn't win, is it this further right candidate? And if so, what does that mean for the future of the Republican Party? Remember, Democrats are also putting up their own candidates. This is going to be competitive not only today, but again in November.
Emily, the playbook here is simple. Ronald Reagan invented it. Maybe it goes back before Reagan. In a primary, you run to the extreme, and in the election, you come back towards the middle to get elected. But that's shattered, isn't it?
I mean, there's a certain question. If you run super far to the right or to the left, it's going to make that much difficult to come back to the center and that much difficult for your party to win. I mean, remember, the big picture here for Republicans is not, is it Oz who wins today? Is it McCormick? Is it Barnett? The big picture is, are they going to get enough votes that they can control the Senate in after 2022? And they're going to need states like Pennsylvania to be able to do that.
What are the legislative implications, Emily, if the Republicans do take the Senate?
I mean, there are a number of potential things. I think, of course, it depends exactly how much they take the Senate by. I mean, right, we've got a 50-50 Senate right now. Democrats technically have control, but we've seen them fail time and time and time again to be able to move President Biden's agenda forward. Republicans could find themselves in a similar situation if they only have a slight majority. But it basically means that they could wind up having major issues if Biden wants to nominate additional individuals to his cabinet or to the administration. Republicans could really delay and back that up. And I think most critically, if Republicans take control of the Senate and we get another opening on the Supreme Court, there is a good chance, given the precedent that we've seen, that they're going to deny Biden his potential nominee. And that could lead to another giant battle like we saw after the passing of Justice after one of the other justices several years back.
You know, Emily, we've been talking a lot about the lines being drawn when it comes to the inflation situation and how that's going to be framed heading into the midterm elections. How have the lines been drawn in these primaries?
I mean, there are a couple different ways. It's interesting, Lisa, my election reporter brain, when you think lines draw, I keep thinking about redistricting and how much of an impact that is having, particularly in the House races. But really, I mean, I think there's been a big question. Again, a lot of it goes back to the hold that Trump has on the party. And as we saw last Tuesday, that is still pretty significant. You saw the Trump-endorsed candidate advance in the Ohio Senate primary. Of course, that's going to be another competitive one come November. And you also saw some of his endorsed candidates in other competitive races. There was a House race in West Virginia. Trump-backed Alex Mooney won over David McKinley, who's another Republican and had support from really elsewhere in the party, as well as a number of really big donors backing him. So I think tonight the big question is, what is going to be the power of Trump's endorsement? Are we going to see a continuation of the pattern that we've seen in previous weeks?
Emily, thank you. Down in D.C. on the path forward. These politicians, Washington, D.C., facing down a big problem right now, a cost of living problem. Governor Andrew Bailey of the Bank of England was talking about this just yesterday, Tom, and once again made some questionable headlines. He was asking people, higher paid workers, to, quote, think and reflect about asking for more money. He went on to say, in the situation we're in, which is very difficult for low-income households and particularly difficult where inflation is concerned, it's important to bear that in mind when you are thinking about these things. It's Governor Bailey to politicians just yesterday, TK. Asking people to pull back on asking for a raise isn't going to make you the most popular man in the room.
Well, we mentioned that yesterday, the uproar of the under-cabinet secretary. I don't know the details, John, in England, but you're basically saying go out and find a better job. To be clear here, the financial markets, John, are separate. We're looking at an update today. Who knows what the markets are going to do? That's not our job to guess it. But this inflation story, and particularly globally, the food story, is separate. I'll be honest, John, I looked at the World Economic Forum website today as we traveled to Davos, and I was thunderstruck of how removed they were from the food crisis that exists right now.
You're thunderstruck that the World Economic Forum is tone deaf.
No, I'm thunderstruck on rice and wheat. I think this is really serious.
It's the least surprising thing ever that the World Economic Forum is tone deaf. It always has been.
In the zeitgeist this morning, the U.S. said to India, would you let up on the export ban? And India is doing that. There's a little more distribution of Indian wheat.
Lisa, looking forward to getting a taste of this next week.
Are you? the tone deafness? Honestly, it's true. It's basically people talk about wealthy individuals going to talk about wealth inequality.
Oh, there we go.
No, it is what it is. But
Occupy Davos with Bramos.
Occupy Davos.
Futures up 1.8 on the S&P, on the NASDAQ up by 2.1%. From New York, this is Bloomberg. Live from New York City this morning. Good morning on TV and radio. Marko Kolanovic over at JP Morgan thinks we're pricing in too much recession risk. Speaking to that, maybe, if you want a data point, the earnings from Home Depot, a beat and a raise. Speaking to that, maybe Warren Buffett putting some money to work in Citi. We can talk about that later. Futures right now up by 1.7% on the S&P, on the NASDAQ 100, up another 2.1. There's your squeeze, there's your bounce, whatever you want to call it. We had the Fund Manager Survey out of Bank of America today. You had the cash levels at levels we haven't seen for a long, long time. Growth optimism at record lows. Have we priced in too much into this bond market too? Let's talk about that in the bond market. 2s, 10s and 30s, and the scope for higher yields after hitting 320, a year-to-date higher 10-year just a couple of Mondays ago. Your 10-year right now, 291.49, yields higher by 3 basis points. One thing that has returned is that inverse correlation between equities and bonds. Equities higher, treasuries lower, yields up. That's something to keep an eye on as we work our way through this session. Into the FX market, euro-dollar shaping up as follows. We are at 105.20 and a little bit of a pop, some euro strength. And the beliefs over at Deutsche Bank, Lisa, that maybe we can get out to 110 because tightening financial conditions will push the Fed away and the ECB is yet to come in. That's one view. I know a lot of people looking at the other side of the trade.
Yeah, talking about parity or even below. But to really edify George Saravelos' point out of Deutsche Bank, we actually just got data from the euro area economy that came in better than expected, that the economy grew more than people had previously been pricing in. So how much does that really support this idea that perhaps too much bad news has been priced into the euro?
There is an ECB meeting on June 9th, Tom, and I promise you just might stay awake through the whole thing.
It's going to be fascinating, and quite frankly, all the Fed speak. I mean, Ibrahim Rabari at Citigroup, John, lined up the central bank speakers today.
I know.
And it was like 2 or 3 banners long on television. For those of you on radio, you're advantaged.
Lisa said the same thing about 30 minutes ago, Tom. Who is not speaking today? Who isn't speaking?
I was snoozing when Lisa was on, excuse me.
I know. You give that away sometimes.
I think it's obvious to everyone.
Okay. Are you comparing Bramo to President Lagarde?
No,
really?
Well,
Come on.
I think I would.
I'd love it if Lisa did that news conference.
Christine Lagarde to...
I'd love it if
Would
Lisa
it be a
did
snooze
that.
fest?
That would not be a snooze face. That would be epic. I'd love to see what happened to the peripheral bond market after you'd finished speaking.
I was about to say, just check the Italian bond market and talk about how much it tanked.
And yes, folks, as we announce that we will be going to Davos, we can assure you as we look back 10 or 12 years, and good morning to Stephen Roach, who lived Occupy Davos. It is Occupy Davos with Bramo. The Bramo cam will be traveling to Davos, just so you know. It's in a specially hermetically sealed anvil case. Shall we move on, John?
Yeah, well, let's move on.
Let's move on. Michelle Meyer is legendary at Bank of America for careful analysis of the housing market and the American consumer. Even better now with MasterCard. She has the data of MasterCard on what consumption is doing. She's chief U.S. economist for MasterCard Economics Institute. What's the distinction you see in the MasterCard data?
Good morning, Tom, Lisa, and John. The data, as we've been just talking about, has shown a really still solid consumer. Right now, the transaction data, the insights that we're looking at is showing the consumer is still outspending, and has actually been pretty stubbornly resilient. Now, as we look forward and we think about all of these different factors that are driving consumer spending, the fact that they're sitting and looking at high prices, the fact that borrowing costs are going up, the fact that we are seeing a shift in this economic cycle towards more moderation, we should see that start to show through in the data. But in the meantime, we're just seeing very trend-like and strong spending trends here.
People like you go into deciles. You look at 10% of America, another 10%, another 10%. Can you state the middle class will be crushed by this inflation?
No, I don't think that's right. When you look at the fundamentals of the household sector, and you think about particularly that poor middle class, that's a population that has been able to accumulate savings over the last several years. So, you saw the chart that was just shown a little bit ago, which earlier on the morning show, which had the level of outright savings, which is the differential between what is going in, your income, and what is being spent. So the actual savings rate has come down, but that stock of savings is still really high. And debt levels are still really low. So that middle income consumer that has that savings still out there that could be used and access to credit should be able to, buffer some of these headwinds that we're seeing right now.
Okay, so Michelle, with your MasterCard mug right next to you, as you talk about this, you are seeing signs of revolving loans picking up, right? Basically, people might be spending a lot of their savings, but increasingly they're actually charging this and taking out credit. How much is the American consumer levering up to fortify their spending at a time where costs are skyrocketing?
Look, it is just starting. It is just starting that, you're seeing consumers start to take on debt again after the last year and a half of deleveraging. So unlike a typical recession, this past cycle with COVID, consumers were able to reduce their debt level because they had so much additional income coming in that they were able to use to support their spending trends. So you entered this cycle. We're in this recovery with a very low debt level relative to what you would normally see in a business cycle. So that's extremely helpful and an important point to make. So when you think about now the ability to use their credit cards more, it is certainly there. And you are seeing, if you look at the G19 data from the Federal Reserve, revolving credit is picking up. It has been picking up for the last several months, but relative to where we were prior to the pandemic, we're first getting back to those levels as an outstanding level for consumer credit. So I think that there's plenty of room left to go for consumers to use their credit cards to help support spending trends.
Michelle, you sound really bullish. Are all the people worried about recession just basically worrying about the sky falling?
I think that there's the idea of looking at what the data is showing right now versus trying to think about the different range of outcomes. So the data right now, when you look at the high frequency data in the economy, it is strong. Consumers are spending, businesses are investing, you still have inventories to rebuild. There's still momentum left in the economy. Of course, we're going to slow from the 5.5% growth rate we had last year. Something closer to 2.5% is a lot more reasonable. So that's going to feel like a big shift in economic growth. You're going to see job growth from the 450,000 pace that we've been enjoying to something closer to trend as well, which is probably 100 to 150,000 a month. So that change in the economy, I think, is what people are so focused on and worried about. But the reality is that we were overstimulated last year. We were running well in excess of what we should have been for the economy. So we're now moderating back to a proper underlying trend. As we look further into our crystal ball, sure, we have the Fed that's hiking. We have the Fed that's trying to execute this great rebalancing, which is going to be tricky. And I think that's what they're focused on, is how well do we get to this proper landing in the economy?
Michelle, I want to build on something that Lisa asked, and I think it's so important. And your answer too, you said plenty of room to go. Does that have implications for how high the Fed has to go to curtail demand?
Yeah, so that is a critical point when you think about this terminal rate in the hiking cycle, is that we're looking at an economy that has a very large, what we would call, buffer right now. You know, you see a lot of spending still going on. You still see a good incentive for investment. So for the Fed to rebalance or support the rebalancing in the economy, they do need to cool demand, and they're coming from a high point. So in that regard, you know, unless there's a big support from the supply side, which helps to get to that rebalancing, presumably it means that the Fed is going to have to push a little bit more than certainly we had seen in the prior few cycles. So I think that's really, really critical. This is not the last business cycle. This is a very, very different environment.
Michelle, what is the dynamic you see away from MasterCard on the international effect on American GDP and the recession call? And this would be the mix of our export growth and our import growth. Is it going to be such a drag that gets us towards a summed recession, even though the domestic economy is better than good?
Well, it also goes back to what you were talking about with these pretty huge moves in exchange rates, given the relative differences in growth across the economies and the monetary policy across economies. To me, when I think about the international story, I'm actually most focused on how that's impacting supply chains, particularly the goods side of the economy, where this imbalance has been the most acute throughout the cycle, where the U.S. consumer has been actively buying these goods, big ticket goods, vehicles, electronics, home appliances, and furniture, and the supply chain has been impaired. So the extent to which that gets resolved because of support from the global environment, because of healthier growth abroad, perhaps changes in COVID policies, I think that is a critical factor to how we think about how far the Fed has to push and when we get this equilibrium in the economy that we're all kind of waiting for.
Michelle, can I have a MasterCard mug? Can we make that happen?
We'll get one to you.
Thank you.
Absolutely. We'll exchange. I'll take a Bloomberg one.
It looks very cool.
That was a blatant swag request.
I have been requested to make Bloomberg surveillance mugs with good morning on, which I think would probably sell quite well, TK. You'd have one. My mum would have one. Michelle would get one.
Yeah,
Lisa's family would have one.
They good. We have a supply disruption I ordered months ago, John, from China.
You're still waiting.
And I'm waiting. They just say Tang on them.
You're getting a Tang mug.
Oh, no. Yours says go to cash.
I think that's a shot glass, Tom. That's not a mug.
You've got a shot
glass.
No,
we did the shot glasses. We sold out of those 8 years ago.
Futures this morning. Good morning to you all. Are positive on the S&P 500 by 1.7%, on the Nasdaq 100 up by 2 full percentage points. Lisa asking, I think, the most important question of the interview. Just how much scope is there for consumers to take on more leverage? And this is an argument that Deutsche Bank and Matt Lazzetti has made repeatedly, Lisa, that household balance sheets are stronger this time. And for that reason, they've got more space. And because of that, this Fed has to go higher. It has to go higher. And that's what separates, say, the Matt Lazzettis of this world from, say, Priya Misra of TD.
And Michelle basically edifying that idea, saying, yeah, you know what? That's true. And if the Fed is worried about consumer demand, they're going to have to slow things a lot faster than they're doing right now because they are still taking out credit and they are still spending.
We'll get the view of Jan Hatzius of Goldman Sachs, the chief economist, following his downgrade to U.S. growth over the weekend. That's coming up shortly from New York City. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Elon Musk is casting more uncertainty over whether he will actually buy Twitter. Musk says he won't move ahead with his $44 billion takeover unless Twitter can prove that bots make up fewer than 5% of its users. Musk has said he believes there are far more fake accounts. Meanwhile, Twitter says it is committed to completing the deal at the agreed upon price. The U.S. Senate has overwhelmingly voted to move towards passage of $40 billion in aid to Ukraine. Monday's procedural vote sets up Senate passage of the legislation as soon as Wednesday. The package of military and humanitarian assistance has been held up by Republican Rand Paul, who has demanded changes. Abbott Laboratories reached a pact with U.S. authorities that would allow it to begin making baby formula again at a troubled plant in Michigan. That could help ease a shortfall that has rattled many parents. The Abbott plant has been shut since February after 4 children who had been fed formula made there were sickened by bacteria. 2 died. A court still has to approve the agreement. Home Depot boosted its outlook for the year after a surprise increase in first quarter revenue. Same-store sales rose some 2.2%. There was continued strong demand for home improvement supplies despite rising interest rates because customer transactions fell in the quarter, but the average ticket increased. A multi-year saga came to a close Monday night at Sotheby's in New York. The final batch of artworks from the divorced couple Harry and Linda McGlow brought in $246 million, combined with the first sale of their art last November. Their 65 artworks totaled $922 million, making it the most valuable collection ever sold at auction. Global news 24 hours a day, on air and on Bloomberg Quick Take. I'm Ritika Gupta. This is Bloomberg.
This drop in industrial production in China in April is going to affect the shipments that arrived here in May and June. So that means that we are not even beginning to feel, or just now beginning to feel, the impact of this slowdown. The worst is not behind us. The worst is yet to come on this side of the Pacific.
Really optimistic, fluffy rainbows and ponies and all of that from Carl Weinberg there of High Frequency Economics. Right on the same page as Bramo.
I was about to say.
With Tom Keene, Lisa Abramowicz and Jonathan Ferro. This is Bloomberg Surveillance. Equity futures up by 1.7% on the Nasdaq 100, up by 2 full percentage points. Nice lift in this equity market. Nice lift for this name right here. Home Depot up by 3.65%. If you're just tuning in, a beat and a raise. Transaction volume a little bit lower, but ultimately the average ticket price, TK, heading in one direction, higher.
Life goes on, and corporations will adjust in every flavor. Obviously, energy companies, John, are going to adjust by trying to hide what the profits are there. This with Brent crude now well over $115 a barrel. I think, John, that's something we really haven't focused on. But, you know, I'll tell you, with retail sales coming up, John, it's a mystery. There's no other way to put it.
8:30 Eastern. Looking forward to the number, Tom.
In China right now, with a terse conversation that does affect America and Europe, Enda Curran is with us in Hong Kong. And I want to go from Hong Kong and the headlines of Shanghai to Bloomberg's reporting of a protest at Beijing University. And there, one of the professors talked about, quote, deep unhappiness. What's a level of deep unhappiness among the leadership of the government in Beijing?
Well, there has certainly been speculation that at the top of the government, some officials are more concerned about the impact of COVID-0 than others. Tom, we certainly know, again, in terms of open source material, people on the ground are obviously upset in terms of the disruption to their daily lives. But as always, though, you know, we can't be too very scientific about this. There isn't any outward sign of division per se. And we know that the government as a whole is continuing to reinforce the broad COVID-0 approach, even though that is having the impact on the economy that it is having. Some light at the end of the tunnel for the residents of Shanghai today, but the bigger picture remains that they are sticking to that policy, even if there is some division at the highest ranks.
Is there a vaccination plan in a given big visible city or across China?
Well, one of the interesting things to come out of the Omicron outbreak in China over recent months has been the spotlight it has put on the slow vaccination rate of the elderly in particular, Tom. And that was actually a problem that we had in Hong Kong as well. And there's a feeling that that's one of the real reasons China cannot move on or adjust its COVID-0 policy very much because, of course, with the obvious ramifications that would have. Now, we know with Sinovac, three shots have proven to be effective, not as effective as the mRNA, but it does seem to be safe and effective, and it does its job. But clearly, they are still behind. The authorities say that they are a vaccination population, of course, but there are studies that suggest that part of the population in particular is vulnerable. And that's one of the reasons why the authorities can't really make an abrupt pivot overnight.
And forgive my skepticism, but do you really believe that China, both the mainland, we know Hong Kong has moved away from this policy, but still has the zero COVID policy at a time where you cannot get zero Omicron virus cases? It just really, as we've seen in the U.S., and frankly, if you're going to have any kind of immigration, any kind of traveling whatsoever, seems highly challenging.
Highly challenging is right, Lisa. I think at the very least, even though they call it COVID zero or dynamic zero, at the very least, what they want to do is to control community spread, to really limit the kind of big outbreaks, and that will avoid them having to go into full lockdowns. But even doing that is going to surely be disruptive. We're getting a sense of that out of Beijing, where there's like heavy ongoing daily testing requirements for the residents there. It's not technically under lockdown. Some parts of it are, but not all of the city. And one would assume that those kind of measures will need to stay in place, again, just for monitoring and surveillance of Omicron. But it's going to really test COVID zero over the coming months. It breached the defense of Hong Kong. And in fact, to your point, the Hong Kong leader today said the city can live with X hundred cases a day, so long as it's not going wildly out of control.
Which really raises a question about what kind of travel there will be between the mainland and Hong Kong if the mainland still adheres, even in name, to a zero COVID policy. How much dissent is there building as people get their freedoms crimped, basically having to be locked into their apartments for days and days, struggling to get food?
There is a lot of frustration. So there's frustration among residents, obviously in Shanghai in particular. We've seen that play out on social media. It's been widely documented. There is frustration among the business community. The foreign community are speaking out loudly through the chambers of commerce, both in China and in Hong Kong. They speak to the difficulties they have in traveling in and around China and, of course, traveling internationally, getting staff in and out. And then, of course, there was a broad feeling that it's not sustainable, this policy, regardless. Now, China has had big dividends from it. Let's not forget it had an economic dividend for 2 years. The economy was allowed to grow because it didn't have the virus. And of course, it avoided a public health disaster. But now it's in a new space. And now this COVID zero is really being tested by Omicron. And I think there are a lot of questions about just how long the government can stick with it.
And an unfair question, but let's go there because it's Unfair Tuesday. Can they even hold the party Congress? We sit there and we see 2,000 people in a room clapping ever so politely. Can they even hold that Congress given the lockdown?
Well, they held the Winter Olympics, and that was held up as something of a success, Tom, in terms of how they ran that bubble system. They've been running a bubble system for some factories as well, although you hear different accounts of just how practical that is. So when it comes to the Congress, again, as Lisa's saying, clearly that's going to be very difficult to have a gathering like that and not have infections. But nonetheless, if anyone can do it, China can. They will put in place a system whereby there will be quarantine on arrival and there will be testing, and it will all be done in the weeks in advance of the actual Congress itself. So very challenging to pull off, but if any system can do it, probably China can.
Enda, thank you. As always, Enda Curran there from Hong Kong, breaking things down on Hong Kong and on the mainland as well. Happening quietly in the background here, crude higher for a third straight session. Yeah. We're back to 115, guys, on WTI, 115 and 5 cents. Brent crude, $115 and about 14 cents, Tom.
When you see a spike up like this, John, and it has been a spike, I can tell you from exactly a 102 level to 115, I look at the moving averages, which are subjective. It depends which moving averages you use. The model that I use, we just crept above the peak moving average of March, John. Emotionally, that's a huge deal. Even though it's a one-day spike to 115, it feels high, even though we've recently been up near 140.
Elisa, just to recap the year-to-date moves. WTI up by 53%. Brent crude up by 48.
Yeah, and frankly, we've gotten a lot of fluctuations in that. But one place where we have not gotten fluctuations is in the refined products. So as oil prices go higher, the refined products like gasoline have gone yet higher still because there has been a shortage of refineries and frankly, services there. I'm watching this closely because this is how it percolates out into consumer spending. This is how it percolates out into the bills that people pay at home every day.
Have we met the point of demand destruction just yet?
You know, we're seeing it certainly with airlines, right? They're cutting back on diesel, but in the United States, this has been the dilemma. People can still lever up, they can still spend one way or another. And does this present more of a problem to the Fed?
Jan Hatzius, the chief economist at Goldman Sachs, coming up next on this program. Looking forward to that for our audience worldwide. Heard on radio, seen on TV with Tom Keene, Lisa Abramowicz and Jonathan Ferro, with futures higher 1.65% on the S&P. This is Bloomberg.
You're starting to see inflation peak, but where are we going to level out at?
We're near a great shock. I don't know if we're going to unravel.
The markets are doing 110% of the Fed's job.
There's a lot of room to go for financial conditions to tighten and really for the Fed to deliver on the hikes.
The question is, will there be, for example, further shocks to the system that mean inflation stays elevated?
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Equity futures positive 1.6%. A beat and a raise from Home Depot. TK Walmart, a beat on revenue, a miss on EPS.
We're going to see what we get as a beat and a raise at 8:30 this morning with retail sales. That's not Home Depot, but nevertheless, one of the tones we're hearing here is the resilient consumer. Michelle Meyer just with that, with MasterCard.
Lisa, here's the line from Walmart. The bottom line results were unexpected.
Yeah, honestly, trying to understand, but how much is this really a supply chain story? How much is this basically the unraveling of the buy cheap goods and sell them for a small margin story that Walmart perfected for so many years, as we do get a lot of the supplies slowed down from China?
The company saying, Tom, the results reflect the unusual environment we're in right now. I think most people would agree with that.
Yeah, they would. Down 4% here pre-market, down $5.98 is one of the quotes I have on Walmart. John, it's going to be every company for itself. As we mentioned earlier, the energy companies are going to hide the profits. But everyone else, it's going to be a mystery. Not only up the income statement to revenue, but just as importantly, John, their ability to handle the inflation someone like Jan Hatzius is talking about.
The numbers from Home Depot speaking to that a little bit earlier on in the last hour, Tom. The fact that transactions were down, but the average transaction was up.
Yeah.
The average ticket price. That's an important story.
Yeah, it is. And everyone's going to parse these dynamics of inflation, the unit dynamics of it, as well as the price dynamics of it. Up at the revenue line, remember, there's two pieces to revenue, John. How many units you move and the price change of those units. And that's sometimes underplayed.
Futures right now up by about 1.6% on the S&P. On the Nasdaq 100 at the moment, up by 1.9%. Yields on a 10-year look a little something like this. They're higher by 3 or 4 basis points to 2.92 in the FX market. Euro dollar firmer by 0.8% at 105.17. That euro, Lisa, just a little bit stronger. And George Saravelos of Deutsche Bank thinks there's more to come.
Yeah, basically saying that any kind of downside surprise could end up hurting the expectation for how much the Fed can hike, whereas people haven't really priced in how hawkish the ECB could get. We got some economic data out of the euro area this morning that showed an upside beat. So how much are people going to come around to the George Saravelos view of things versus everybody else's who see parity or below?
Ton of Fed speak today.
Yeah.
Chairman Powell a little bit later. Lisa, do you think he's got something to say, considering everything we've heard from former Fed officials who don't think he's maybe doing a good job at the moment?
Honestly, what can he say? So Ben Bernanke, the former Fed chair, came out yesterday and said that they waited too long. As a result, they're facing stagflation. Increasing number of academics on both sides of the aisle saying that the Fed really missed the boat here. How does he defend himself? He's saying he's going to stay the course, be data dependent. How does he take the narrative away from people who are basically saying they're well on the back end of this and they have to get going?
8:30 Eastern Time, retail sales just around the corner. Joining us now, I'm pleased to say, is Jan Hatzius, the chief economist and head of global economics and markets research at Goldman Sachs. Jan, coming off the back of a weekend where you actually cut the outlook for U.S. growth, so let's start there with a why.
We cut the outlook because there's been a very material tightening in financial conditions over the last couple of months. Our financial conditions index is up by more than 200 basis points from the end of 2021. And we think that that's going to keep growth below trend over the next several quarters, over the next year or so. So we're now looking for only 1.25% growth this year on a fourth quarter to fourth quarter basis. and then 1.5% next year. And I think that's needed to create a little bit more capacity in the labor market in particular, alongside an improvement in labor force participation, because we have this huge gap between labor demand and labor supply. We've got 11.5 million open positions and 6 million unemployed workers, and that gap needs to shrink, as Chair Powell has said.
Jan, I want to talk, I got 8 ways to go here, but I do want to talk about sub 2% GDP. And one of the partitions here is domestic final sales, or a view of the American economy versus export-import dynamics on the other side. And your colleague, Zach Pandel, then can throw in dollar dynamics as well. Is your call a foreign call, or is it a domestic call?
It's really a domestic call mostly. That's the main driver here. I mean, first quarter had a lot of noise in the trade statistics. I think some of that is going to unravel, but I think it's really about higher interest rates, lower stock prices, somewhat wider credit spreads, and to some degree the appreciation of the dollar. But all of those different drivers, which are primarily going to impinge on domestic demand, slowing growth to a much lower pace.
Do you see any indications at this time that the labor economy is easing? Is it in the micro data that you look at every week?
Not yet in the data, no. I think there are some signs in the more anecdotal reports, company by company reports, some of the tech firms scaling back hiring, lowering open positions. In the hard data that get published by the Labor Department, not yet.
Jan, how high does unemployment have to get to reach that sort of spare capacity that you're looking for in the labor market?
I actually don't think that the unemployment rate has to rise a lot. What needs to happen, I think, is that companies bring down open positions. So the path that the Fed's targeting is to slow growth to a pace that is slow enough for companies to shelve some of their expansion plans and bring down some of their open positions, but not so slow that you start getting large numbers of layoffs. So we're expecting a little bit of an increase in the unemployment rate from the 3.5% range to the 3.75% range, but not a large increase.
Do you think that basically Michelle Meyer was correct when she was talking about the ability for consumers to lever up even if their incomes aren't keeping pace with the inflation rate right now, and that basically the Fed has to go a lot faster even still than people seem to think in order to slow that? Otherwise, we're going to get even more overheating.
Well, I think borrowing is going to be a short-term driver of spending, and I think has been to some degree. If you look at the consumer credit numbers over the last couple of months, there clearly has been some, re-leveraging to some degree. But I don't think that that's going to be a lasting kind of, support for spending. So I think consumer spending is going to be relatively slow. Income is going to be quite weak in 2022. We're looking for only 0.5% real income growth on a fourth quarter to fourth quarter basis. On an annual average basis, actually significantly weaker than that, but even on a Q4 to Q4 basis, only 0.5. And I think that's going to keep spending pretty soft.
Long ago and far away, there was Dudley and McKelvey and this young whippersnapper from Germany. What was his name? I think it was Hotzius is what it was. And you codified MEW, mortgage equity withdrawal. Let me cut to the chase, Jan. When does the housing market break?
Well, MEW is actually a very important issue again. Not as important, I think, as going into the 2008 crisis, but there has been a pickup in mortgage equity withdrawal over the last year. And you've had this increase in consumer credit as well. Similar kind of dynamic. This supports spending in the short term, but ultimately is not going to be a sustainable source of big increases in spending. So builds in a slowdown sort of down the road. And I think, when the housing market slows, of course, is going to determine the timing of that. We haven't really seen significant slowing in the hard data yet. I do expect it. Mortgage rates are up even more than 10-year Treasury yields.
I just ask because Ferro wants to know, should he buy in June or July?
I'm not going to give him advice on that. That I think is probably not
advice I was after, Jan. Don't worry.
That's too long term for Jan.
Jan, let's finish here just quickly. What's the biggest risk right now to your view?
Well, I think the Fed is still trying to bring down, slow the economy, slow employment, and bring down open positions because they're still worried about inflation being too high. And it will be well above target for the foreseeable future. I do think it's going to come down. But if it doesn't come down quickly enough, we can see, still significantly higher rates. Our call at the moment is 3 to 3.25% for the funds rate. We've stuck with that. And it's, fairly close to market pricing. But I think the risk case is that, they have to do more. And that then also raises the risk of a hard landing. Not our baseline, but that would be the risk.
The upside risk to rates, clear and present. Jan, thank you. As always, Jan Hatzius there of Goldman Sachs. Ton of retail earnings to get our teeth into. Home Depot in the previous hour, a beat and a raise from Walmart. The opposite. The stock is down by more than 6%. The CEO saying this. US inflation levels, particularly in food and fuel, created more pressure on margin mix and operating costs, Tom, than we expected.
I'm going to go, I don't have it in front of me, the data, but I went to Michelle Meyer on that with all of her wonderful work at Bank of America and now at MasterCard. And John, I'm sorry, it's a decile or even a 5 percentile study. And I think the summary is real simple. The middle class gets crushed, and that's what Walmart's seeing.
It's pretty clear this morning that you can pick your data point, Lisa, and confirm your priors. For the people with a more constructive outlook, they'll speak to Home Depot. For a less constructive outlook, they'll point to Walmart.
Walmart is unique also in saying that the way that they try to deal with the increase in material prices, the increase in the input costs, is to try to absorb more of them to keep prices low because they have that much more of a price-sensitive clientele. How much are they a precursor to other stores, frankly, of what we're going to see with margin pressure? And that, I think, is going to be a big question mark for them. How much do they plan on continuing to absorb and how high can they raise prices before they see a problem?
The stock is down by more than 6% in early trading. More still to come. Futures positive 1.6% on the S&P, on the Nasdaq 100 up by 2 full percentage points. From New York City for our audience worldwide. Heard on radio, seen on TV, this is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Elon Musk says he'll go ahead with his $44 billion takeover of Twitter, but only if the company can substantiate its claims about the proportion of bots on the service. Twitter says fewer than 5% of its accounts are fake. Musk says he believes the number is a lot higher. Meanwhile, Twitter says it is committed to completing the deal at the agreed upon price. Turkey's President Recep Tayyip Erdogan has put the brakes on NATO's Nordic expansion. Erdogan says he won't allow Sweden and Finland to join the alliance because of their stances on Kurdish militants. Erdogan called Sweden a nesting ground for terrorists. Several EU defense ministers are optimistic that Turkish concern can be resolved. And the euro area economy grew more than initially estimated at the start of the year. GDP rose 0.3% in the first quarter. European consumers emerged from the pandemic with pent-up demand and large amounts of savings. Still, the war in Ukraine has added to cost of living concerns by stoking energy prices and adding to already record Eurozone inflation. And Home Depot boosted its outlook for the year after a surprise increase in first quarter revenue. Same-store sales rose 2.2%. There was continued strong demand for home improvement supplies. Despite those rising interest rates, customer transactions fell in the quarter, but the average ticket increased. Warren Buffett's Berkshire Hathaway said goodbye to one long-time bank stake and made a big bet on another one. A filing shows that Buffett ended his long-running investment in Wells Fargo in the first quarter. It was once Berkshire's biggest common stock bet. Meanwhile, Berkshire has now invested roughly $2.9 billion in Citigroup, which has a new CEO in Jane Fraser. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Season is here.
A very good quarter against an incredibly choppy backdrop.
The uncertainty is palpable.
We are cautiously optimistic.
Bloomberg breaks the numbers first.
JP Morgan, spot on.
Delta flying. Beat on fixed income trading, on equities trading.
With exclusive expert analysis.
It's a stunning statistic.
Bank earnings not resonating with investors.
What's the disconnect here?
Are they bracing for the worst?
Can the market still go higher?
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
demand from Finland, from Sweden to become members of NATO. They will receive a strong support, I'm sure, for all member states, because it increases our unity and it makes us stronger. And this is just the country of what Putin was willing to achieve.
That was Joseph Borrell there, the Vice President of the European Commission from New York City. This is Bloomberg Surveillance. Good morning to you. At 1.6% on the S&P 500. Futures elevated, pushing higher on the Nasdaq 100 by almost 2 full percentage points. Two stocks to watch. Home Depot, the gains in the pre-market fade. The stock is higher now by just 2.2%, a beat and a raise from them. Dealing with the inflationary story as follows. The average transaction is higher, even as the volume comes in a little bit. Transactions fell in the quarter. They indicate the average ticket price actually increased. For Walmart, we got a bad story to tell. We're down by 6.6% in early trading, and there is a clear, Lisa, a very clear inflationary hit.
All right, let's just talk about the numbers. Basically, adjusted earnings fell to $1.30 a share versus the average of nearly $1.50. But they also see profits falling by about 1% this year, compared with a prior view of mid-single-digit gains, all because of supply chains and how much they're having to pay workers. Basically, this is the story that we were expecting: margins to come in, to be compressed, profit to come down, as they try to avoid passing all of those costs along to the consumer. I wonder how much this is turning into a bifurcated story of the tiers of income earners, who can actually afford the costs and who can't.
You know what the reaction will be from some, Tom? Why were they surprised by this? The Walmart CEO saying U.S. inflation levels, particularly in food and fuel, created more pressure on margin mix and operating costs than we expected.
I can't convey, John, the cultural difference between the House of Langone and what they do in Bentonville, Arkansas. These are two completely different markets, companies. There's a housing boom out there. I assume that helped out Home Depot. But, you know, we tend to lump them all in. Microsoft's like Apple, et cetera, et cetera. And,
to Lisa's point, different markets,
hazardous.
Tom, different things.
Yeah, I think that's a case, but, you know, it sets us up for 8:30 this morning here, John. An hour and 10 minutes. This retail sales report is not a small item.
I couldn't agree more. What's the consumer price tolerance?
Yeah.
They're facing down a series of headwinds right now, Tom.
Yeah.
Just how strong is that consumer? We've been told repeatedly, month after month after month, the consumer sentiment in America, University of Michigan, that number, decade lows, Tom, once again.
You saw it in Bank
lows.
of America. Let's go back to 6 a.m. Bank of America with the confidence numbers really pretty weak.
Well, Main Street, Wall Street. We talked about Main Street. We can do Wall Street. You go through the numbers from the Fund Manager Survey from B of A, highest cash level since 9/11, growth optimism at a record low, and the biggest equity underweight going back to the spring, summertime of 2020.
Let's talk to somebody happy. Emily Wilkins joins us from Bloomberg Government in Washington. Emily, I'm going to, be very careful here and cite Alice Cooper, the acclaimed economist from a number of years ago, in his great song, School's Out Forever. Okay, school's out. Ms. Psaki is leaving the White House, et cetera. Let's assume it's a one-term Biden administration. When does he clear a house? When does he reinvigorate the White House?
Well, if he's going to do it, he might need to do that before November of 2022, because if Republicans do wind up taking the Senate, it is going to get a lot harder for Biden's nominees to wind up getting through that chamber. I mean,
what's he waiting for? I don't understand what he's waiting for.
I mean, I guess the question is, who do you think needs to be kicked out? What do you think needs to be invigorated at this point? I mean, you have seen Biden swap out a number of individuals, such as those who deal with COVID. You've seen a couple of other changes. You've also seen a long time to get some of these nominees really in position and confirmed and approved. I mean, some of them have really not been in position for quite a long time, given that this administration took control, in January of 2021. And so you sort of have this wider sort of range of things throughout the government. I mean, the issue for the Biden administration right now, it really comes down to inflation. It really comes down to the economy. And there's really only so much that can be done there. And I mean, you just saw the Senate go ahead and give Jay Powell a very strong green light for another term.
Maybe change the deck chairs on the Titanic, but Lisa, come on. They're acting like it's a two-term presidency. Can they get away with that luxury right now?
Well, I think that there's a lot of skepticism about that, just given the fact that Joe Biden is the oldest living president to serve in office so far. There is a question, though, about the Fed and their role in crimping growth. Emily, we're in a strange moment where politicians want growth to essentially slow to stave off inflation. How do they message that at a time when people are still able to buy things things, if perhaps more uncomfortably, they still are.
It's been really interesting, Lisa, to see how Democrats have messaged on the issue of inflation. When you ask them about it, they kind of change the topic very quickly to pricing and how they want to make things cheaper for Americans. Things like the cost of prescription drugs, for example, or childcare. That's really how Democrats have been messaging on this. And I think it really speaks to the larger issue that there's not a ton that lawmakers in Congress can do to address some of these main root concerns of inflation. Of course, a big question is, are they going to be able to pass other major spending bills over some of these inflationary concerns? I'm not even thinking about that slimmed down Build Back Better bill, which at this point seems to have no time left to actually come to an agreement. I'm thinking about that $10 billion that the White House requested for COVID funding. That's something that Democrats say they still want to pass, that they're still working on. It's something we've heard from administration officials that they need to continue combating this pandemic. But at this point, there's just no momentum among Republicans to pass legislation like that. It got stalled before on immigration provisions, and there are serious concerns about cost. We've seen those concerns about cost spill over into something as popular as support for Ukraine, with those 57 Republicans who voted against the bill in the House, and then, of course, Senator Rand Paul with his concerns in the Senate, delaying progress on that legislation.
Emily, thank you. Emily Wilkins down in D.C. TK, you've got two choices. You can make policy with the Congress you have, or you can try and make policy for the Congress you don't have. And if you do the latter, you're not going to make policy. Bottom line. And at the moment, I hear less about policy and much more about blame. Trying to direct blame elsewhere.
Totally
Corporations not paying enough tax. If you want solutions, you have to focus on making policy for the Congress you have, not the one you want.
Well, maybe that's a British way. I think in America we're so polarized, John, that basically there was an election and we decided to believe there was a strong Democrat majority. And the gentleman from West Virginia has pushed against that with a gentle lady from Arizona as well. And the bottom line is it's much more polarized than the Biden administration thought a year ago.
The 50-50 Senate split didn't speak to that at the time, Tom.
No.
I mean, seriously, come on.
I think 20 years from now they're going to be writing about this. It reminds me a lot of the 1890s, frankly.
Lisa?
I mean,
honestly, nuance doesn't sell. You're seeing this on both sides, right? I mean, you have basically no cohesive plan from the Republicans either. Just look at how bad the Democrats screwed this up. The Democrats are saying, it's the corporations, and everyone else is saying, we don't really get what you actually want to do. Nuance does not sell.
When it's just about blame, it's just about campaigning. That's it. That's all it's about, the march to the midterms. Futures up 1.7% on the S&P. From New York, this is Bloomberg. Pick your poison this morning. Your equity market's doing nicely. On the S&P up by 1.76%. On the Nasdaq 100 up by more than 2 full percentage points. Said it a little bit earlier, you can choose your data point, Home Depot or Walmart, just to confirm your priors. For your outlook, you're more constructive, look to Home Depot. Transactions a little bit softer, but the average ticket price a whole lot higher. That's the story for them. For Walmart, surprised by higher costs. I know what you're thinking. Surprised, really? It's all we've talked about for the last 4 or 5 months. That stock is down and down a whole lot. Remain's going to run you through that in just a moment. For your equity market, we're looking to the fund manager survey from Bank of America, the biggest underweight in equities that we've seen going back to 2020. Cash levels we have not seen since 9/11. Growth optimism, the lowest on record. Have we priced it enough at the front end of the yield curve in America? Let's look at bonds, 2s, 10s and 30s. Bank of America say no. Mark Cabana thinks we can get to 350 on a 2-year. Right now, 261.74. And Michael Harnett over at Bank of America, Tom, saying the following. He thinks we haven't seen full capitulation just yet because he believes, because we're still looking for rate hikes and not rate cuts, we're not there yet.
And what's important, John, is the capitulation and what it does not to the equity market, but what it does to the bond market. And it'll be fascinating to see that emotion of capitulation and what it does to the 10-year.
And then from the bond market to foreign exchange. So let's go there to euro dollar. Lisa, this is how Deutsche Bank's thinking about it.
Price is over.
To what Tom just said, when you start pricing in too much, recession risk, financial conditions get too tight and the Fed has to back away, but the ECB can step up and step in and hike rates. That's the scenario. Maybe getting a little bit too cute. That's your view, your opinion. But that's the scenario that Deutsche Bank and George Saravailos are looking for, Lisa.
And on their side is that they're going against consensus. So people are pretty heavily positioned, at least in words, to this idea that we could get to parity with respect to the euro and the dollar. At the same time, we are getting better than expected data out of the eurozone, at least today. We'll see about tomorrow. They are more exposed to China and they're more exposed to the oil prices.
Retail sales in America 1 hour away. Euro dollar right now 105.33. That's the cross-asset price action. Let's get you some single names. A lot of earnings to talk about. Let's say good morning to Romain. Good morning, Romain.
Hey, good morning, John. And a lot of it is going to center around the consumer and those retail sales numbers in about an hour's time. We did get earnings this morning out of Home Depot and Walmart. An upside surprise for Home Depot, a downside surprise for Walmart. Despite the divergence in those stocks right now, the story, believe it or not, for both of those companies is pretty much the same. Walmart down about 7%, Home Depot up about 3%. Home Depot able to make up for some of the softness in foot traffic by higher ticket prices, but a lot of that, again, appears to be somewhat adjusted on an inflation basis, even though the company doesn't break that down. Meanwhile, Doug McMillon over at Walmart, the CEO there, saying in the earnings statement that there was the inflationary pressures on his consumers, particularly when it comes to fuel and food, caused a sort of a different mix in what people were buying. It didn't specify exactly, but you get the idea that consumers, at least over there at Walmart, appear to be making some trade-offs about what they can and cannot afford, and that really is the story, the big setup heading into that 8:30 a.m. retail sales report here in the U.S. Meanwhile, last night, United Airlines came out and said they're actually expecting a pretty good summer, reaffirming a lot of their guidance for the year and saying that they're still seeing a pretty good groundswell of consumer demand. At the same time, they did talk about higher jet fuel prices and just their ability to continue to pass some of those prices on through to those ticket prices. Keep an eye on that space. For now, investors like what they heard. Those shares higher by about 5% here on the day. You talk about Warren Buffett and what he sees in the economy. Those Thursday net filings that we got yesterday show him finally closing out that stake in Wells Fargo, taking a stake in a lot of consumer lenders, including Citigroup, a 2.9% stake there. Those shares higher by about 5%. And Ally, that's the big auto loan company, those shares also rallying this morning. So maybe Buffett and his team see some opportunity there on the credit side, or on the loan side, I should say there. Over there in China, some headlines crossing the wire just a little while ago here with regards to that big meeting with a lot of the Chinese tech companies and the government there. The vice premier over there saying that the Chinese government does support these platform companies. Those shares higher by about 8% here in the pre-market on Alibaba, and most of the other Chinese ADRs also rallying this morning. And then back here in the U.S., Twitter shares continue to sink lower, Tom. Those shares down about 1.5% on the day as you continue to see a lot of nonsense going on with what Elon Musk may or may not do.
Romain Bostic, thank you so much. The close this evening with more on Walmart and Home Depot. Right now, we are all aware it is yield up and price down. That is the mix, the toxic mix for something rare in the last decades, a bond bear market. Winnie Caesar's living this as global head of strategy at Credit Sites, and she knows, well, you can talk about spreads and you can analyze loans in different categories. And the answer is price is down, and she joins us this morning. I want to look at the Bloomberg Total Aggregate Index, Total Return Aggregate Full Faith and Credit Index, and the answer is we're down 12% in price, 7% analyzed. Can you state it's a bond bear market?
It feels like we're in a bond bear market, and from talking to the credit investors that I speak to on a regular basis, they are certainly seeing a lot of signs of kind of continued negativity. Don't fight the Fed is definitely the mantra in the bond market, and the Fed seems to be on a very hawkish course to continue to hike rates. That being said, there are some signs of kind of constructive positivity on the credit market side of things.
Right. Well, no, but in the equity market, I claw back on growth. I claw back on use of cash. How do you claw back from a 12% loss? Frankly, in IG, it could be an 18% loss. What's the strategy to claw back in fixed income?
So in fixed income, we've had two phases of the sell-off. First, it was all duration. We saw higher rated, longer duration assets sell off as we saw that big sensitivity to the move in yields. Now, with everybody very concerned about growth, we're moving into the credit risk phase of the sell-off. And this means you have to be very selective in terms of where you are positioning your risk. And that is actually a very good sign for these dedicated credit investors who have longer-term views and longer-term mandates rather than kind of a 3 to 6 month time horizon like we usually see in the equity market.
Winnie, with about an hour to go before we get retail sales, when you take a look at the corporate fundamentals, which sectors are starting to feel the biggest hit from some of the weakness that at least we saw in Walmart, if not beyond?
So we're definitely seeing a shift away from some of the COVID pandemic darlings, some of the consumer staples and retail side of things. But we are also seeing a continued improvement in energy fundamentals. While we might not hold energy prices where they currently are, the levels are still going to be quite strong for cash flow and credit investors. And we're also seeing some idiosyncratic risk in some sectors, things like high-yield healthcare and high-yield telecom. We're seeing some single-name stories that are really driving outsized spread widening in those specific sectors.
There's sort of an existential question facing credit right now. Yes, borrowing costs are a lot higher, but companies don't really have to borrow. And if they don't have to borrow, does it matter, right? I mean, does it actually affect their bottom line? When do companies have to start borrowing again and actually locking in these yields that are incredibly high relative to where they were a year ago?
That's a great point, Lisa. And I would also say the yields are high relative to 1 year ago. But let's not forget that 1 year ago was the absolute rock bottom for borrowing costs, a level that we're probably not going to see again, at least for a long period of time. And so even if borrowing costs have moved up by, call it 100, 150 basis points in investment grade, from a long-term perspective, that is still a very low level of borrowing cost. And in fact, the amount of no issue that we've seen this year has been quite robust because a lot of companies are looking at those current borrowing costs and saying, well, you know, this is actually still not a terrible time to be continuing to add debt to the balance sheet, continuing to refinance transactions. And then in the high yield market, that's where we've seen the most liability management, really giving a lot of these issuers a reprieve from having to go to the capital markets. And we probably have another 12 to 24 months before there's really a lot of urgency, especially for the higher rated parts of the high yield market, the double B issuers.
Winnie, this presents a real issue for the Fed. And we were talking about this on the consumer side with Michelle Meyer of MasterCard. But if a lot of these companies are immune to more substantial Fed rate hikes, at least at a financing level, how high can the Fed raise rates before it presents a credit issue?
So I think that the way the Fed looks at the credit markets is functioning of capital markets. Are deals pricing? Is there investor demand? And for the investment grade market in particular, deals are still pricing, albeit at pretty steep new issue concessions relative to last year. And order books have been relatively solid. So I think the Fed is looking at the investment grade market and saying there are clearly some technical challenges going on in this market, but from a borrowing perspective and pure liquidity flowing, we can continue to hike rates. Now we're in kind of the approach to the danger zone, 150 basis points of spread. You usually don't hold that for very long in the IG market. Either you break one way or the other. And if you break to 200, that's when the Fed has to take a little bit of a pause and say, are capital markets still functioning?
Winnie, wonderful to get your views. Winnie Caesar there of Credit Size. We're approaching the danger zone. Bramo, it sounds like something you'd say in the credit market, the danger zone.
I mean, you know, it's what I know. That's what people, that's how people speak.
We're starting to see a move in spreads, starting to price in some credit risk. Most of the year has been about interest rate risk and now starting to price in some credit risk.
Right. People are now starting to price in what could be a potential recession at a time when a lot of companies don't have near-term maturity. So even if there is a recession, you could get a scenario where the default rate doesn't pick up all that much. How do we deal with that in the credit side? And then what does that mean? I keep going back to this. For the Fed, again, all of these levers that normally would get triggered when the Fed raised rates, whether it's in the consumer or the corporate sector, are not going to get triggered as they raise rates this time, giving them a lot more leeway for them to raise rates. This is a new paradigm than what we've seen in recent years, John.
We're so used to the idea that financial conditions tighten, Tom, and the Fed backs away. This is different. The Fed's focused on something else, and the pressure's on them not to back away, at least through this summer. I say at least through this summer. There are many people who believe that we get to the end of the summer, the Fed reassesses, and they do back away. But for now, this is it. And I think that's why many people, when you ask them their 3-month, 12-month price target, particularly Goldman, their 3-month price target is pretty neutral. It's where we are. Ask them their 12-month, this belief that the Fed backs away, that we've priced enough in and things start to improve at the back end of the year. We'll see.
Whatever anybody does, if they back away or not, John, the fact is rates moving is nonlinear. And the question is, when does that nonlinear feel break in? I would suggest it's not June, but maybe July or the meeting after that. I'm focused on July.
I'm focused on Jackson Hole, August, Tom.
It's okay. It's a little early in the morning.
An important meeting.
You know,
for the powers that be over at the Fed and for global central bankers too.
I can see the Bramocam there on the peninsula overlooking the swamp with the elk in the distance.
That's going to work.
Cue the plea for
But on
the
a serious note,
road
Lisa,
trip.
I think for global central bankers, that's going to be an important moment. What's the trend for inflation once we get out through the summer?
How many more 50 basis point rate hikes can they do?
Futures up 62, up 1.5% on the S&P. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Elon Musk is casting more uncertainty over whether he will actually buy Twitter. Musk says he won't move ahead with his $44 billion takeover unless Twitter can prove that bots make up fewer than 5% of its users. Musk has said he believes there are far more fake accounts. Meanwhile, Twitter says it is committed to completing the deal at the agreed-upon price. Shares of Walmart are falling. The world's largest retailer missed analysts' estimates on first quarter earnings and scaled back its full-year growth outlook. Walmart also missed on its gross margin, citing higher supply chain costs. The U.S. Senate has overwhelmingly voted to move towards passage of $40 billion in aid to Ukraine. Monday's procedural vote sets up Senate passage of the legislation as soon as Wednesday. The package of military and humanitarian assistance has been held up by Republican Rand Paul, who has demanded changes. Meanwhile, Treasury Secretary Janet Yellen has called for large-scale assistance to Ukraine. She says it needs to be similar to the Marshall Plan that helped rebuild Europe after World War II. Yellen said the money pledged so far won't be enough. Abbott Laboratories reached a pact with U.S. authorities that would allow it to begin making baby formula again at a trouble plant in Michigan. That could help ease a shortfall that has rattled many parents. The Abbott plant has been shut down since February after 4 children who had been fed formula made that were sickened by bacteria. 2 died. A court still has to approve the agreement. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
For the first time in Fed history, we have 2 policy tools, the balance sheet and rates. The first time in history of the Fed, with 2 policy instruments, it may be able to escape crashing the economy to bring inflation down to its target level.
That was Bill Lee, the chief economist at the Milken Institute from New York City. This is Bloomberg Surveillance with Tom Keene, Lisa Abramowicz and Jonathan Ferro. Futures up by 1.6 on the S&P, on the Nasdaq up by about 2 percentage points. Crude pushing higher by 1% to 115 and about 30 on WTI. Euro dollar 105.48. That currency pair stronger on the euro side. That currency pair moving 1 full percentage point and some. Steve Englander of Standard Chartered just published something very similar to the thoughts of George Saravelos over at Deutsche Bank, Tom. He said the following: we still think the market is too aggressive on Fed hiking expectations, and the ECB, he says this, is just beginning to step up its language on normalization, and that is a big part of the dollar weakness that we expect in the second half.
Well, it's there, but how much dollar weakness? I mean, you can get a resilient dollar. I think of Mark McCormick at TD Securities, who's been brilliant on this. I mean, is a 104 DXY back to 102 dollar weakness? I don't think so.
Oh, we saw 103 on euro dollar last week, Tom. My question would be this: give me the reason why the Fed's going to back away. And if it's because of weak growth and the ECB is hiking into that, typically when the global growth story weakens, Tom, I'm going to the US dollar, not away from the US dollar. So we'll see.
A week ago, John, you walked through the economic data of the different Fed meetings. I'm sorry, the script is boring. They're going to wait for the economic data. The next meeting is somewhat of a layup. And then what? And that then what is the beginning of the summer.
I think it's probably more boring than that, Tom. The data's in. They've got to make a move. And then they're going to collect the data over the next 3 months, sit there in late August and reassess things. That's the guide that I'm hearing, at least from Chairman Powell, and maybe other people hearing things differently. We'll hear from him a little bit later.
Give me an intraday on Brent crude, folks. Right now on radio, all you need to know is from the lower Gartman left to the upper right. John, breaking out, rounded up moments ago, a 116 a barrel.
We're pushing it, Tom. 115.50 right now on
there
Brent.
It is.
WTI too, push higher.
And you have to line up and know that at Walmart is one example. Pumping a gallon of gas doesn't make up for what it does inside the box. Jennifer Bartashis is with us with Bloomberg Intelligence. She's truly expert is what is inside the box. Jen, what's the battle at aisle 14 of a given Walmart coast to coast? What is the battle in a given aisle 14?
The battle in the aisle is the food inflation that's happening and inflation in some of the other categories where it's really affecting the way consumers are spending, and it's changing the mix of what they're spending. And Walmart has to combat these rising costs on their side and hold back price increases as much as they can.
Okay, steak to chicken. I mean, that's what we saw. We saw it with Tyson Food. If I go to Walmart.com and I look at a steak, because, the Abramowicz clan's coming over tomorrow, $29.30, $12 a pound for USDA choice steak. People are substituting, aren't they?
Absolutely. We're seeing that happen across the store where people are trading down into cheaper proteins. That's where people are going to chicken, they're going to other things. And that's happening across lots of different categories. People are stretching their budgets. But what's interesting when we look at Walmart, because it is sort of that canary in the coal mine for the retail industry, is that traffic stayed the same. So people are still going into stores. Inflation is pushing the top line up, but people are just being a little bit more judicious on where they're spending their money.
Jen, surveillance correction. Lisa, I'm sorry, I mentioned steak and poultry shift as well. I see the Suncor Foods organic, gluten-free, black seeds, 15 ounces are, what people are rotating to.
Thank you. And actually, young Brema will be very happy to hear that that's what's on the menu for tonight's dinner. Thank you so much, Tom. I do wonder, Jen, how much we're seeing the breakdown of a model that for so long was the classic American model of basically selling a lot of things cheaply. And the way to do that was by importing things. The way to do that was not paying people a certain amount or past a certain hourly wage. There's also a whole host of other ways that they made this work. Is this model broken?
I don't think that it's broken, but I think that it is in the beginning stages of just evolving even further. We are seeing where wage pressure has altered things, that all these companies are paying higher wages, which is a good thing. But the model itself, in terms of finding ways to offset those higher costs, are really where the focus is. So how can you improve your supply chain? How can you improve your transportation? How can you change things where you can save costs but not impact your consumers? And that's really where the focus is.
How much is Walmart an outlier, and how much is it really a tea leaf for what's to come for other stores?
Well, traditionally, Walmart is a company that generally performs well in almost any environment. And so it is a company that a lot of people look to get a sense of how the overall average consumer in the United States is behaving. And so when we look at where that consumer is spending, is it skewing towards food? Is it discretionary? That gives you then a read through to some of the other retailers that are out there. So it is important in that respect.
Jen, wonderful to get your view on things. Jennifer Bartash there of Bloomberg Intelligence. Walmart down by 6.6%. What has been the biggest change over the last few months, the last 9 months compared to the previous cycle, the previous 10 years? We used to talk a lot about cheap money underpinning the valuations, underpinning the business models of, say, an Uber. What's changed, Lisa? You touched on it. It's the price of labour. Joe Weisenthal has done, I think, out of everyone in the financial media, the best job of staying on top of this story. When we used to think about Uber, a loss-making company, Lisa, we used to talk about free money, cheap money, funding these business models that were ultimately unsustainable. The element of it that we didn't talk enough about was the cheap labour aspect. That was the biggest point, and that's been a massive change that's affecting many of these companies.
Right, so how do they change the model? Is it just that consumers pay more, or is it some combination of automating certain processes on the back end to try to get more efficient mix? Frankly, a lot of people would say this is a welcome change, right? Workers should be paid more.
Absolutely.
And that, frankly, a lot of people were living just below the poverty line and working their butts off. And frankly, I know I shouldn't be able to say that on surveillance, however, but it's the truth. So are we moving to a more sustainable model? How do we get there right now, John?
Some companies won't survive in that world, Tom. Pretty clear. If it sticks around, if it stays, some companies just won't survive in that world.
That's normal in any shakeout as well.
Of course.
But this new labor model, John, is going to be a huge deal. And I'm sorry, with American CEOs at Davos, is there any other topic? I don't think so. They're going to want to talk about macro babble and all the rest. It's about labor.
It's more than the macro babble, Tom. It's things about the transition. It was easy to talk about the energy transition a couple of years ago.
Yeah, exactly.
At the World Economic Forum in Davos, Switzerland, I'd say it's a little bit harder to talk about the same thing now, TK. Really tough.
It's going to be interesting to say the least. And one thing I'd say, John, is the consensus that I saw over the weekend is the wage spiral fear is not in place yet, even with the labor dynamics that Jan Hatzius has talked about in this hour.
In the UK, it might just start to be biting, maybe, Lisa, just a little bit. Maybe that's starting.
Yeah, maybe that's starting. I gotta say, I wonder how much the UK, frankly, is a model for what's going to happen in the US. People are saying it's completely different. It was bitten by Brexit.
I get it.
All these things, but at the same time, it's the S word.
Bitten by Brexit, Tom.
John, there's some job openings at Arsenal.
Are there?
Yeah.
Do you want to take one of them?
No, I'm not qualified.
They were terrible yesterday. Newcastle United were fantastic. From the first minute. From the first minute, Arsenal just did not show up. The final game of the season this weekend, Tom.
Well, they're underpaid.
Yeah. Okay. Futures up 1.5%.
Right now, we are just bordering on calling for a recession.
If we did get one, there's a lot more room for spreads to widen and kind of even exacerbate those losses that we've already recorded.
There is some room, even in a recessionary environment, for some market upside you don't want to miss.
If inflation does moderate, the underlying strength of the economy is enough to possibly support a soft landing.
The first time in the history of the Fed, with two policy instruments, it may be able to escape crashing the economy to bring inflation down to its target level.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio, on television. An important 8 o'clock hour, Wall Street time. Retail sales. John, it's simple. I can get the full English breakfast, thank you, Twinings, at Walmart for $6.54. Let's link Walmart into what we're going to see in 29 minutes.
Did you just confuse a full English breakfast with breakfast tea?
Yeah, I was working on the fly.
What it sounded. Okay, all right.
Thank you.
Looking forward to it, Tom. 8:30 Eastern Time, retail sales. And then later, as Lisa pointed out repeatedly through this morning, the reaction from Chairman Powell a little bit later this afternoon. Tom, we've said repeatedly on this show, we know how consumers feel. They tell us in the surveys. They don't feel great. The consumer sentiment numbers out of UMich, decade lows. What are they doing? We'll get a little snippet of that a little bit later this morning.
This is so important, folks. We're going to review what we talked about 2 hours ago. And, John, we're going to do this with a backdrop. We've got a guest coming up that says calm down about inflation, but there's no calm in the Bank of America Fund Managers survey.
Absolutely not. Cash levels, Tom, the highest since 9/11. Growth expectations are at record lows, and market participants have responded to all of this. You've got an allocation to equities and underweight, which is the lowest since 2020, Tom. JP Morgan's Marko Kolanovic thinks we've priced in too much recession risk. He's pushing back. He stays pro-risk, Tom. Others will take the other side of the trade as we work our way through summer.
And, of course, we're on our way to Davos here. We're really getting into final preparations, folks. And, of course, the song will echo across Happy Valley. The hills are alive with the sound of gloom. And that means Lisa Abramowicz in full attendance this year. Lisa, the gloom is in the bond market. Price down, yield up.
Yeah, and that's really been what's driving, at least a lot of people think, the gloom in equities, because it's a full sale repricing. When it comes to retail sales, what's better or worse for the bond market? If we get a good retail print, does that mean the Fed has to do that much more to really crimp the growth, to crimp demand, to crimp some of the inflationary pressures? And if we get a weak print, is that actually a good thing? Because that means that perhaps we're starting to see some moderation in some of the trends. Honestly, things are getting flipped on their head in a major way, Tom.
Brent crude on the data, John, $115 a barrel. Link that data and commodities into the Aramco headline just out on it. What again, John? It's the fifth time they've done this. An IPO here in the oil boom from Aramco.
Well, this will be the trading unit, Tom. The trading unit IPO, something that apparently they're considering, according to our reporting, according to sources. The trading unit could be valued at over $30 billion. They're lining up the banks, said to tap Goldman Sachs, JP Morgan, Morgan Stanley for that potential trading unit IPO. The valuations, Tom, sky high right now in that particular part of the world.
Could Elon Musk be involved?
I'm not sure about that, TK. I'll let Elon Musk speak for himself. Would you like to talk about the Twitter deal? Is that what you're trying to go to?
No, let's lose the Twitter deal. Let's talk about what matters, which is Brent crude 115, rounded up 116 an hour ago. Even with the good tape I see, John, and the data check we need to do, Brent front and center.
How much belief is there, conviction, that some of these moves stick beyond midday? Futures up 1.5%, the Nasdaq up by 2%.
Fair.
That just tells you about the lack of confidence still after we've been beaten up in this market so badly over the last few months. Yields higher by 3 basis points. That inverse correlation is back. Equities are higher, treasuries are lower. Yields are bouncing by 3 basis points. 291.31, 320 the high 2 Mondays ago, Tom. 291 right now.
Very good. Now joining us, and this is a really important conversation for you on radio and television, because Scott Clemens, with 30-plus years of Brown Brothers Harriman, synthesizes in all the eco-babble into the market strategy. And your foundation, Scott Clemens, is everybody calm down about inflation. If you're briefing Chairman Powell today and the 47 other Fed speakers, how do you tell them to calm down about inflation?
Tom, I think it pays to be a simple-minded economist, given all of the moving parts that you laid out here at the top of the hour. I would remind the Fed, far be it from me to lecture the Fed, but I would remind the Fed that the price of everything and the price of anything is simply the interaction of supply and demand, and that the Fed has an ability to influence demand through monetary policy. But the Fed does not have the ability to influence supply. So to the degree that lingering inflation is a result of lingering supply chain disruptions, the Fed should not get overeager and raise interest rates too much to try to choke off inflation that ends up not being demand-driven to begin with. I think that's the story for inflation and the Fed for the balance of this year.
Scott, let's talk about the story for this market. Marko Kolanovic of JP Morgan in the investment bank saying we're pricing in too much recession risk. Just two-part question. One, do you agree? And two, how do you measure that?
I think that's right. I think the market is too pessimistic about the risk of inflation. In an environment where we're adding jobs at roughly, let's call it 500,000 jobs a month, net wages are rising. Combine those things together, keeping in mind that personal consumption is 68% of GDP. Going to 23, 24, yeah, there's a recession out there somewhere, but I don't see that in the near term. The backdrop is just too strong. Where I think the confusion or the anxiety arises is we're still in the midst of this transition of economic leadership away from the policy support of easy monetary policy and a lot of fiscal spending 12, 18, 24 months ago, back to a more normal driver of economic activity. That's naturally anxiety inducing. I get it, but I think people are looking at the glass as being half empty. There are a lot of half full notions out there as well.
Well, are half full notions something that would encourage the Fed to hike further, leading to half empty? And I know this sounds like a parody of what it is to be gloomy, but honestly, this is what a lot of people are thinking, that the momentum that we're seeing in a lot of the economic data is a bad thing because it means the Fed has to do more. What do you say to counter that?
Well, Lisa, I think the answer to that is what's really important, and this is a subtle nuance, but I think this is the source of a lot of the volatility in financial markets. The important thing is not that the Fed is raising interest rates, but why they're raising interest rates. And admittedly, that's very subjective. But if the Fed on one hand is raising interest rates out of growing confidence that this transition in leadership is taking place, that's a pretty benign and even supportive outcome. If on the other hand, the market concludes that inflation is running away and the Fed is playing catch up, that's a very disruptive outcome. And I think the push and pull between those two notions is what drives market volatility, not just day to day, but sometimes even hour to hour. We've all seen these days in which the market opens strongly and closes in the red, or vice versa. Hopefully today's opening holds. But I think that's likely to continue for some time to come. We're telling our clients to get used to the kind of intraday volatility that has characterized the beginning of this year. It's not going to go away anytime soon.
So given that, where's your highest conviction right now, Scott?
Well, with the rise in interest rates, we've begun allocating capital into traditional fixed income for the first time in close to a decade. For our clients at Brown Brothers Harriman, taxable clients, municipal bonds are offering a better trade-off of risk and return than we've seen in quite some time. Beyond that, the carnage in equity markets has left a lot to find. I take a very simple measure and look at the percentage of stocks in an index trading below their 50-day moving average. As of last night's close, 78% of the S&P was below its 50-day moving average, 96% of the Russell 2000, and 99.95% of the NASDAQ is trading below its 50-day moving average. That doesn't mean that everything is cheap, but it certainly means that among that carnage, there are plenty of good trade-offs of risk and return.
Scott, let's think positive. Let's say you go down in flames with your inflation call. Instead of getting 2 to 3% inflation, you fail. You're wrong, and we get 4.2% inflation by the end of the year. That is a sea change from where we are right now. What does the stock market do if Clemens is wrong?
That's probably more disruptive for the stock market if Clemens turns out to be wrong. I think, though, at the same time, the trajectory of inflation is important. If at the end of this year, the inflation number still starts with a 4, but we're headed in the right direction, that's different. In that environment, I would want to own companies that have pricing power, companies that can pass through those higher input costs to their end customers. That tends to be associated with brand loyalty, essential products and services, repeat customers, all the kinds of quality markers of a company. Not that they're immune from an inflationary environment like that, but they're a lot more resistant to it.
Great to catch up, Scott. As always, a different perspective on things at the moment. Scott Clemens of Brown Brothers Harriman. Someone said to me the other day, Lisa, that it wasn't about glass half full, glass half empty. It was whether you could find any liquid in the glass right now as you look at the next 12 months. Some people struggling to do so.
Which is perhaps why they're hoarding cash right now. They want that liquid in the glass when it's clear whether it's half full or half empty. This is an issue that we're seeing, the lack of conviction stemming from a Federal Reserve policy we have not seen in the modern era. It is unprecedented, and it's unprecedented in how much it's joined by the ECB and, frankly, by a lot of other central banks other than Japan.
So the team over at Walmart is breaking down the earnings on the analyst call at the moment. And our team here at Bloomberg has given us some insight as to what is going on. Just on wages, the first item that the CEO calls out is a wage increase. Our team goes on to say the company ended up with more employees than it expected as people came back from COVID leave more quickly than expected. It left the company with weeks more staffing than it needed, apparently. Then the company resolved that issue during the quarter, mostly through what they say is attrition. The bigger issues, let's go on to say, it's not just about the labour market. Supply chain costs and the shift in spending away from general merchandise, which typically has higher profit margins than groceries. That, for many people, Tom, is going to be the bottom line.
Yeah, it is. A substitution effect here is a huge, huge deal. And a lot of people, John, frankly, I would suggest haven't lived it. John, I'm sorry. One of the first screaming fits I had at Bloomberg was over words like attrition.
Yeah.
I believe that's firings is like what they're trying to say.
Or just letting people leave and not
attrition. What the hell is attrition?
Letting them go and not, yeah.
Yeah.
I know. How many screaming fits have you had since?
4 or 5, that's all.
Just, is that all? Is that on? Is that the daily average? Is that the daily average?
It's a daily average. You know, we go to a tenth of a screaming fit.
Team's still tallying that up.
Where's my tang? The tang is terrible.
1.5% on the S&P.
It's too dilute.
From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Rishika Gupta. In the UK, the government is about to take a step that is likely to escalate tensions with the European Union over trading arrangements in Northern Ireland. Britain will lay out legislation designed to override parts of the Brexit deal in the coming weeks. Foreign Secretary Liz Truss says the UK would rather reach a negotiated solution with the EU. It plans to proceed with the legislation in parallel with talks. Elon Musk says he'll go ahead with his $44 billion takeover of Twitter, but only if the company can substantiate its claims about the proportion of bots on the service. Twitter says fewer than 5% of its accounts are fake. Musk says he believes the number is a lot higher. Meanwhile, Twitter says it is committed to completing the deal at the agreed-upon price. Turkey's President Recep Tayyip Erdogan has put brakes on NATO's Nordic expansion. Erdogan says he won't allow Sweden and Finland to join the alliance because of the stances on Kurdish militants. Erdogan called Sweden a nesting ground for terrorists. Several EU defense ministers are optimistic that the Turkish concerns can be resolved. And it could be one of the world's biggest listings this year. Bloomberg's learned that Saudi Aramco is considering an initial public offering of its trading arm amid that boom in oil prices. People with knowledge of the matter say the trading unit could have a valuation of more than $30 billion. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Buying season is here.
A very good quarter against an incredibly choppy backdrop.
The uncertainty is palpable.
We are cautiously optimistic.
Bloomberg breaks the numbers first.
JP Morgan, spot on.
Delta flying. Beat on fixed income trading, on equities trading.
With exclusive expert analysis.
It's a stunning statistic.
Bank earnings not resonating with investors.
What's the disconnect here?
Are they bracing for the worst?
Can the market still go higher?
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
The Fed is still trying to bring down, slow the economy, slow employment, and bring down open positions because they're still worried about inflation being too high. And it will be well above target for the foreseeable future.
Jan Hansius there of Goldman Sachs, the chief economist, on the path forward. From New York City this morning, good morning. Equity futures positive 1.5% on the NASDAQ 100, up as well by 1.85%. Two names to talk about, Home Depot and Walmart. They're dealing with the inflation story differently. Transactions at Home Depot just a little softer, but the average ticket higher. That stock is up by 3%. Walmart down by 6 percentage points. Tom, this issue about moving away from general merchandise, focusing on groceries, lower profit margins versus higher profit margins, this is what companies like Walmart right now are dealing with as this cost of living issue gets that much bigger.
We see it in 10 minutes here with the retail sales, the cross-section across America, and the huge body of America, the millions of labor at Walmart. Right now, Dana Peterson's going to be with us here after the retail sales numbers on the economic story. But we are thrilled to bring you now someone hardwired to the retail of America, and particularly the aspiration that all of us are guilty of. Dana Telsey is Chief Executive Officer, Chief Research Officer at Telsey Advisory Group, and lives New York retail truly like no one I know. Dana, I was absolutely crushed at the price rise on the Celine hoodie sweatshirt. The men's, it's got the Celine thing on it. I thought it should be in my closet. I mean, there it was. It was $800 and all of a sudden it's $990. Everything's going up in price, right?
It has. We're seeing price increases, and Tom, thank you for having me. Price increases across the board on many different categories, especially on luxury goods. The consumer is buying, and we're seeing a wide range of consumers buying in terms of demographics and age group. The brand matters, and they find ways to pay for it.
But what is so important here from the days of you at Bear Stearns, where you're doing, channel shops and going through Abercrombie and Fitch, is the way we buy this stuff is fundamentally changed. How important for you and Joe Feldman is Affirm, is PayPal credit, is the access of get that Celine sweatshirt now and pay for it later. That's sea change.
It is a sea change. It's very important. And frankly, it lifts the sales. And also the companies are learning what to produce because of the options that they have, both buying in store and buying online. The world today is more integrated than it ever has. And we're watching sell-through, we're watching influencers, we're watching Instagram in order to pick up what are the trends that are going to mean something on Main Street.
So what are you expecting right now in about 10 minutes time in these retail sales numbers, Dana?
I mean, I think April hopefully should be a little bit better. We saw gas prices come in a little bit. We still have an environment, like was mentioned earlier, a shift to services from goods. We're expecting a big summer season of vacation. The other thing is you have 2.6 million weddings occurring this year. On average, people spend around $430 every time they go to a wedding. So you'll still have some of that good spending. April should have been a little bit better, but inflation is a headwind. And that is in every aspect that companies are dealing with it.
Dana, as people change the way they pay for luxury goods, do we have to change the way we think about who's shopping there? Typically, we think of the high-income earner and the luxury goods, and those two are so closely tethered. I just wonder, Dana, if that's changed now over the last couple of years.
I think it has. I think you've gotten the millennials and the Gen Zs, and I think the brand awareness, the collaborations that have been done is making these luxury brands younger and younger while still keeping the ethos and the interest of the higher income demographic.
So, Dana, as interest rates go up, can they maintain the buy-in? I see the lines outside of the luxury stores in Soho. We all do. We can spot the average age in that line as well. What's going to happen here? It does not look good as you look further forward.
I mean, we need the Chinese to come back and spend. Right now, you were seeing some tourism happen with Europeans coming to the U.S. We'll need that Asian traveler, but the product innovation is key. We've seen what demand can be when newness is out there. You've seen it from LVMH with their brands. You look at what's happening with Tiffany's. You've seen what's happening with Balenciaga. There are luxury brands that matter to these consumers.
There's a bigger issue underpinning John's question, and it's an important one, which is at what point will higher borrowing costs really matter, especially as more consumers do start to lever up in order to keep their purchasing at the same levels as before inflation took off to the way that it is now?
I think overall, the lower income consumer at the lower end, obviously they're struggling. The middle income consumer continues to get some higher wages, and those wages are allocated. It may not be allocated to goods, but allocated to services. Above that mid-tier is the question mark if there's a pullback, given what debt levels could look like.
Dana, your thoughts, and Joe Feldman's work on Amazon has been great, but I'm going to editorialize and say Amazon's been a train wreck. Your thoughts on how they turn it around?
I mean, there's work to be done there. Amazon, the narrative that was 2 and 3 years ago that Amazon was going to take over retail and the consumer spend isn't there. It definitely cost more to be able to ship than ever before. Everyone basically expected what was happening online sales to continue the growth, and we're seeing that shift now. We're seeing the shift of a return to stores from digital sales that's helping the physical store retailer. And frankly, digital sales are moderating. And
Balenciaga is a brand I just don't get, TK. What is Balenciaga about?
You know, to be honest,
the oversized shirts, the oversized shoes.
But, you know, and Dana will be dazzled by this. I actually watched a little short video on the guy, Balenciaga.
Yeah, how did that go?
He went bankrupt like 3 times, and every time he came out, he revolutionized what he did out of Spain.
Sure.
And it was always with drama, John, and I guess that's what it is. I don't get it.
Dana, I'm convinced that in a few years' time, they come out of the head office and say, got you. This was all a joke, but you bought it anyway. I just don't get it.
I think one of the things they do, you can go by their windows like I did last night. They're putting things in their windows that, whether it's big inflated balloons in the look of a person, they're basically creating that something you need to see. And frankly, there's a difference between heritage and authentic luxury, like what you have with the quality of the goods at Hermes, and there's a difference with what's happening now that is in demand because of limited supply. That's what some of the brands are doing.
Dana, what does your universe do when we come off China lockdown?
The luxury goods universe will do very well, but also don't forget what China supplies. Every manufacturer is looking to diversify their supply, and being able to get the goods is key.
Brilliant.
Dana, thank you. Awesome. Dana Towsey of Towsey Advisory
John,
Group.
do you know that these sweatshirts, I thought if you bought a luxury sweatshirt, it didn't shrink in the wash. I got that so wrong.
One thing you've got to watch out for, Tom, is if the other half takes said sweatshirt and shrinks it deliberately so that they can wear it.
Put to bed the idea that women spend so much more than men. I just listened.
Who is insinuating they did?
I mean, that's typically the stereotype, and I just want to point out that's exactly right. Just want to make that very clear.
I would never suggest such a thing. Seconds away from economic data in America from New York City this morning. Good morning, live on radio and on TV. This is Bloomberg Surveillance. Equity futures up by 1.5%, there and thereabouts on the S&P 500. On the Nasdaq, up by 1.9 with some economic data. Here's Mike McKee.
Good morning, John. Well, it looks like Americans are still spending, if not a little bit less than they had been anticipated to spend, with retail sales on a month-over-month basis up 0.9%. That's stronger than the month of March, which had been revised already up to 0.7. It's a little bit less than the 1% that was anticipated by economists. The retail sales ex-auto is up 0.6. That is half, roughly, roughly what it was in March. And retail sales without auto and gas up 1%. And that's important because gasoline and food have especially been taking a bigger part of Americans' budgets. You take a look at grocery stores, they were down 0.1% during the month of April. And gasoline stations were down 2.7%. So that's interesting because we had thought gasoline prices had started to go up again, but since they probably held about steady during the month, the percentage change isn't as much. But here's an interesting thing. On a year-over-year basis, gasoline sales are up 36.9%. So you can see an inflation impact there. A couple of other numbers to point out here. Electronics and appliance stores up 1% after a decline of 5.2%. Maybe that's a little bit of a rebound in what people are buying out of housing. The clothing and clothing accessories up 0.8%. Non-store retailers, this is the group that includes Amazon. Tom was talking about Amazon, 2.1% higher. That is a bigger change than the prior month, which was just 0.4%. And food services and drinking places, which is the one we always talk about in honor of Tom, up 2%. Of course. After 1.9% the month before. So that little extra he had at the hotel the other night.
Contributing as always.
Doing his best for the American economy.
Equity's up nicely here, up 1.3% going into the print, coming out of it too. If you want to see a move, it's at the front end of the yield curve. 2-year yields are higher by 8 basis points. I think we can round that one up now and call it 9 basis points higher at 266 on a 2-year. Seems to me we're trading off the back of, Tom, the ex-auto, ex-gas number, which was an upside surprise, the control group, an upside surprise, and some really decent revisions across the board.
Yeah, the revisions to me are a huge deal. I look at this like on a 3-month moving basis, so the revisions really matter to me. And, John, what's important here on the celebration of the 2-year yield taking a breather, we're halfway back to that 280 level.
266 on a 2-year. That's the question, Mike. You take the data, what does it mean for the Fed? The heat's still on, right?
The heat's still on. It does suggest that we are going to see ongoing strength in the U.S. economy, which is what the Fed wants to see. Jim Bullard, the St. Louis Fed president, just out with some headlines. He's speaking this morning, one of 6 different Fed speakers, including the chairman. I'm not speaking today, but, well, I am speaking right now. And Bullard's saying he expects that household spending will hold up because of the strong job market. He thinks that the tighter Fed policy is already having an effect, and I think he's there talking about the housing sector. And he does not expect recession in U.S. or Europe, even though he said that Europe and China are risk factors for the United States right now.
Mike, before we let you go, we've been talking all morning about how good news may be becoming bad news for the Fed, that basically these numbers coming in strong, and frankly, the upward revision from a negative to a very decidedly positive level for the prior month in the core group, in the comparison control group, really gives the Fed more incentive to hike further. How much pressure does this really put on them to make the 50 basis point moves and then follow it up with additional ones later in the year?
Well, since they've already said they would do 50 at the next 2 meetings, it probably doesn't add a lot to them. What they'll want to see is where they are in July with retail sales. Once we get through the next 2 months, the May and June numbers before the July meeting, and then we'll see where they go when they get to September, because at this point, we know the economy is strong. It's a question of when does that additional weakness we've seen in housing because of higher mortgage rates bleed over into the rest of the economy. Jim Bullard suggesting it's not going to a whole lot, but we'll have to see.
Mike, thank you, sir. As always, Mike McKee, breaking through the data. Upside surprise, Tom. Equity still elevated 1.4% on the S&P. Yields pushing higher on 10s by 5 basis points, on 2s a little bit more. Speaking to the Fed, as Mike echoed, a Fed they're still facing a heat a bit here.
What's changed through the morning, folks? And we've been looking at oil 115 now down to 114.49 on Brent, but all of a sudden 2-year yield is front and center with a 7 basis point move. Dana Peterson provides wisdom now, chief economist at the Conference Board with their heritage of study of the American consumer. Dana, I know you're going to tell me all consumers matter, but which consumer matters to Jay Powell? Is it the Walmart consumer, the housing success Home Depot consumer, the luxury consumer Dana Telsey was just talking about? Which consumer matters?
Well, you're right. All consumers do matter. But I think for the Fed's very concerned about your lower and middle income persons who are struggling with higher inflation, whether or not they're going to start pulling back in consumption because prices are rising. They're also concerned about young millennials who are looking to buy that first home. And certainly as interest rates are rising, it makes it more difficult for them to get out there and acquire that home.
Dana, we're seeing people start to re-leverage, perhaps not so much in the home front, but definitely with credit card spending. We've been talking about that all morning. How concerned are you about this actually triggering more action from the Fed, or perhaps just padding numbers in a way that is unsustainable for the longer term?
Well, I think many people are starting to shift their buying habits. Indeed, our consumer spending confidence survey shows that in the present situation, people are still pretty optimistic. But looking ahead, they are saying that, look, they're starting to buy cheaper products. They're driving less. Maybe that accounts for the slowdown in gasoline station sales in April, as well as a little bit of cooling in the pricing. But they're also thinking about reducing their expenditures on out-of-home purchases. And when it comes to big ticket items, they are saying they're going to delay those purchases. So certainly if people are using their credit cards to supplement their incomes as they're buying necessities, and that is a problem. And certainly higher interest rates will just make their balance sheets even more fragile.
Dana, you pointed to what people are saying. What they're doing may be somewhat different, because we're hearing a lot of pessimism in terms of how people are feeling about paying these high prices. But when it comes to retail sales data, they're coming in strong. When it comes to Home Depot, came in strong. Walmart is its own story. Which side are you on? I mean, basically, are people not doing what they're saying?
Well, just going back to our last consumer confidence survey, the present situation showed that people were still in great spirits. The labor market is doing well. Most people are working. Wages are rising. But the expectations gauge continue to flag, and that signals that people are looking ahead. They're concerned about the economy in the future. And certainly they're expecting that with higher prices and rising interest rates that may affect their consumption, but also may bleed over into their labor market prospects. And so what people are feeling and saying and doing right now is consistent with the data, but also them looking ahead.
On the supply front, Dana, we have guests talking about what I'm going to call a rapid decline in inflation fears. We get to the end of the year and things are just flat out better with less inflation. Do you buy the story?
Well, that's really incumbent upon external factors. Number one, do we see a resolution to the war in Ukraine where you don't see the upward pressures on commodity prices, including food, energy, metals, even semiconductors? It also presupposes that the lockdowns in China don't continue. Certainly, the Chinese government has a zero COVID policy that shuts down entire cities, and that means nothing's produced and nothing's shipped. And so unless we see those external factors be alleviated, then it's hard to imagine a really steep decline in inflation later on this year.
Dana, wonderful to get your views on what's happening at the moment. Dana Peterson of the Conference Board. Lisa, this just goes back to a conversation we have had all morning. The output numbers are decent if you look at retail sales. We're told repeatedly that consumer household balance sheets are really, really strong. And for that reason, people like Michelle Meyer of MasterCard, Matt Lazzetti of Deutsche Bank, I can think of others, Mark Cabana of Bank of America, think the Fed has to go further than many others believe.
Right now, the tolerance to higher rates seems to be a lot higher than some people might want, because it means that the Fed has to go further and really raises a prospect of that downturn. And this is the reason why it could be consistent that people believe that the biggest tail risk is the Fed hiking more than expected, but not worrying as much about the recession in the near term, but over the longer period, yes, because frankly, that would probably trigger some sort of downturn. And that is what a lot of people are trying to bake in to some of the pessimistic views that we're seeing expressed in markets.
I will say, Bramo, we've got to think about where the states are landed. This is numbers for April. We're talking about earnings from back in March. A lot's changed. March through April into May, going through this summer. Things are going to get harder in the view of money.
Things are going to get harder, and it's also important to keep reminding everyone that retail sales are a nominal basis, right? So this means that on a real basis, they are negative. They are going down. We saw that with Home Depot, that the total ticket numbers were down by 8% or more, but in terms of the volume. But when it came to the revenues, they were up more than 11% because of those higher prices. At what point does that bite the real economy?
Chairman Powell, Tom, coming up a little bit later this afternoon. The amount of Fed speak we've got through the day is just phenomenal. What are you looking for?
I'm looking for how many times. It's going to be a drinking game, John. After Arsenal losing,
What is it?
I'm ready. Whoever's is data dependent. I mean, come on.
Is that your new drinking game? You say it all the time.
Look, I'm in the camp, and I had a wonderful conversation years ago with Richard Berner, who worked at Morgan Stanley.
Tell us about it. We've got 30 seconds.
John, just real quick, they're talking too much. Am I wrong on that? There's just too much communication.
The Fed officials?
Yes.
Most people would agree.
There's
talking
too much chat. It's like this show.
Are they all
There's
talking too
talk.
much? But Tom, to be clear, is it all of them, or would you like to hear from just one person a little bit more often?
I'll leave it to a pro on that. I'm not sure.
Okay.
You know.
But they're data dependent.
I mean, when Loretta Mester speaks, I lean forward.
They're
She's
data
a
dependent.
They're data dependent.
They're data dependent.
Excuse me.
They're data dependent.
They're data dependent.
There we go. Futures on the S&P up by 1.3%. This is Bloomberg.
They're data dependent.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Elon Musk is casting more uncertainty over whether he will actually buy Twitter. Musk says he won't move ahead with his $44 billion takeover unless Twitter can prove that bots make up fewer than 5% of its users. Musk said he believes there are far more fake accounts. Meanwhile, Twitter says it is committed to completing the deal at the agreed upon price. The U.S. Senate has overwhelmingly voted to move towards passage of $40 billion in aid to Ukraine. Monday's procedural vote sets up Senate passage of the legislation as soon as Wednesday. The package of military and humanitarian assistance has been held up by Republican Rand Paul, who has demanded changes. Abbott Laboratories reached a pact with U.S. authorities that would allow it to begin making baby formula again at a troubled plant in Michigan. That could help ease a shortfall that has rattled many parents. The Abbott plant has been shut since February after 4 children who had been fed formula made there were sickened by bacteria. 2 died. A court still has to approve the agreement. And Home Depot boosted its outlook for the year after a surprise increase in its first quarter revenue. Same-store sales rose 2.2%. There was continued strong demand for home improvement supplies despite rising interest rates. Customer transactions fell in the quarter, but the average ticket increased. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Most forecasters have the real economy growing at an above-trend pace in 2022 and also in 2023. So just taking that as a benchmark, it looks like above-trend growth for the U.S. economy is the best base case to have. There are always risks around that, but I think that's where we are.
And so it begins an eventful day of Fed Speak. We'll continue forward to this on television and radio through the day. Mr. Bullard of St. Louis speaking at the Energy Infrastructure Council, many others to speak as well. We've got a busy 20 minutes for you to set up the beginning of the markets here with futures up 60. VIX comes in under 27, 26.68. On Walmart, on Home Depot, Kriti Gupta. Kriti?
Yeah, Tom, as we see retail sales on a macro basis actually better than expected. It's worth looking at the divergence between Home Depot and Walmart, but that's not what I do in my chart of the day. I look at Home Depot relative to Walmart, this idea of consumer discretionary spending relative to consumer staple spending, which of course is Walmart. We also know that they love to look at their everyday low prices, which kind of becomes this beacon almost for recessionary spending. This is an important ratio, Tom, because as you look at Home Depot relative to Walmart, that ratio tends to drop in recessions. Guess what it's doing right now? It's dropping pretty steeply from it's the start of the year. And it's important to keep in mind that the way the price action is working is that it mirrors times of recession. But here's the thing. We're not in a recession. You're seeing perhaps a slowdown in growth, but not necessarily an actual recession. And that's why this chart is so important. Is the stock market sell-off overdone?
Kriti Gupta, thank you so much. Greatly appreciate it. It's like the sun coming coming up in the East, you can understand that in any criminal or civil litigation, there are events down the road where you go after the big fish. That is what has happened this morning with a publication by Sridhar Natarajan, our banking senior reporter, which barely describes his expertise on New York and global Wall Street, on Morgan Stanley and on Mr. Wang of Archegos. Sridhar, thank you so much for joining us this morning. Sri, this is about a Hong Kong, I'm going to call it a conglomerate, whatever, online trading, whatever. The stock doesn't matter. And Bill Wang of Archegos, who's got a guy he's dealing with at Morgan Stanley, and it goes the wrong way for Mr. Wang. Is he suing Morgan Stanley here for letting the beans out?
Let's take a step back. We all know what happened with Archegos and Bill Huang just last month. Criminal charges against Bill Huang for the spectacular collapse of his family office. But in a new untold chapter of that collapse, months before his liquidation, there was another big short bet that he had on a stock, Futu, which is the Chinese stake on Robinhood, and he sought Morgan Stanley's help to get out of that position. But soon after that, he was caught in one epic short squeeze. The stock jumped 400%, and he lost nearly $4 billion. At least his portfolio took a $4 billion hit.
To cut to the chase, this is not Martha Stewart or anybody else on insider trading where it's pretty much cookie cutter. Don't you just go back and look at the emails, look at the transcripts and that? Or is this about more clandestine studies within the court system?
And that's where it gets interesting. We have no indication that at the time this happened that Archegos really even thought that there was anything amiss or anything that the Morgan Stanley bankers could have done differently. But since the emergence of the block trading probe by the Justice Department, the other major Wall Street targeted probe from the DOJ, it appears as if the Archegos team has told the Justice Department, or at least authorities, that they should review the transaction and see if Morgan Stanley bankers were indiscreet. There could be more innocent explanations. Futu could just have been caught up in the retail trading frenzy when an army of investors were targeting massively shorted stocks. But at the very least, for what we understand, is Bill Huang and Archegos want the Justice Department, want the other authorities who are looking into it to review the transaction and to make sure everything was on the up and up.
So there's a distinction between punting blame and actually casting liability. What is the potential liability for Morgan Stanley should Bill Wang be proven correct?
And that's where we go in a completely separate track. We know about the Archegos probe, but we also know that Morgan Stanley is the only major Wall Street institution that has come out and said that it is facing a probe into its block trading practices. It has even said that it faces potential civil liability if some of those people making claims against them are proven to be right, where they will have to pay up on their end. There is no indication we have right now that the Justice Department is even taking the Archegos claim seriously enough to go knocking on Morgan Stanley's doors. But the numbers do paint quite a stark picture, and it behooves another look at least.
Is it fair, Sri, to dovetail this particular probe to a wider issue where you're seeing WhatsApp communication, cell phone contacts, all of these individual types of services being probed by the banks themselves, trying to keep track of what their employees are doing at home so they can better deal with regulators in this kind of scenario? How connected is some of that?
There's no doubt we're living in the regime of the everything crackdown. Clearly, the prosecutors, the DOJ, the SEC, there is a change in mindset, at least from the era of the Trump administration, and they're going hard after Wall Street on a number of fronts, whether that's looking into every aspect of Archegos, the block trading probe, the WhatsApp probe, short selling. They are on it, and they're all over it.
Sri, I'm in the triple leveraged all cash fund, so, if I buy 100 shares of Home Depot, I guess nobody cares. If I own 1.735 million Walmart, and I want to unload 266,000 shares, how do I do that?
You won't be able to do it discreetly, Tom, so better make sure you pick your bankers very carefully.
This is critical, folks. I set you up for this. I did. Going into your sell or buy of a block trade that it's going to be visible.
Well,
chatted upon.
You know that the bankers will have to canvass the market, and that's part of the challenge here. A lot of the professionals will tell you when bankers go about their task, maybe there isn't any other way for them to do this. There are only so many restrictions they can place on people they're conversing with.
Exactly.
And that's why the Justice Department may have a tough case to make against Morgan Stanley in the first place.
Thank you. Sri Natarajan there with the obvious fact. I'm sorry, Lisa. I think, and I think Arthur Levitt would be great on this as well. This is not about individual trades, Lisa, or even small insider trading accounts that we mentioned earlier. When you've got 1.691 million and you want to unload 32,000 shares, in some ways, Lisa, it becomes public.
Well, and that's been, frankly, the big argument in bond trading for trying to keep it less transparent, because people don't want to move the market ahead of different transactions. In stocks, the hope is for things to be liquid enough that even a big block trade shouldn't move markets that much, because there's enough of a robust trading market. However, this is a good point, Tom. We have not seen forced selling. We have seen people kind of slowly move away or shift allocations, but not forced selling yet, even with all of the pessimism. What happens? How liquid is this market when there is forced selling, or if there is forced selling, I should say,
well,
Tom?
We haven't heard about it. We got an ebb in the markets here. Brent crude, we can walk away from 114 down to 115 down to 114. Lisa, I'm sorry, the bond market is not there, but it's migrating back to the higher yields of a number of days ago.
Retail sales confirmed a strong consumer, at least a less weak consumer than some people had expected. Well, I mean, honestly, I saw, for example, Renaissance macro research come out, Neil Dutta, actually showing that on a year-over-year basis, retail sales is up some 18%. So it actually is beating inflation. So basically, the health of the consumer gives people confidence the Fed can keep going.
Well, we will see with a lot of Fed speak today. Please stay with us on that. Christine Lagarde scheduled to speak, I believe, as well. Futures up 57, 1.4%. The VIX 26.73. A better market. Stay with us on Bloomberg Radio and Bloomberg Television.